Okay, so we will proceed our event today just a few minutes, so just wait together. And in the meanwhile, okay, everyone got, okay, sorry. Okay, so, right. We also have some time for the previous slide, so everyone should know how to choose the language, which one they want to listen to. So I would like to share my screen again. Okay, so that's easy, okay. So if you are joining this event from the mobile phone, there's option for you if you want to listen to Khmer language, because we have Khmer interpretation. On your device, you can just click on the three dots, the lower hand side, and the icon will pop up as to look like a globe to you, and you can choose the language. There's two languages here, English and Khmer, and you can just click on Khmer if you want to listen to. And if you are joining this from the computer, you can look at your screen on the lower part. You can see the globe icon. Okay, the word on that icon is interpretation. So click on that. There will be language for you to choose. If you choose the word English, there will be English for people who, if we have Khmer, okay, speaker, and you can choose English so that you can listen to the invitation. And if you want to listen to Khmer, yes, just click on that. Okay, any question? If you want to ask me, if you're not sure about how to do this, you can ask us. Okay, right, good question. So everyone is, okay, muted. We are using webinar right now, so not everyone can open the mic to talk. You can ask question to us by writing in the chat box. Okay? Only the speaker, the coordinator, also the organizer can just open their mic. Okay? Right, any questions so far? No? Okay, our event will proceed soon, and I think we need to wait a little bit more because our president will be here soon. And yeah. Okay, so good afternoon to everyone, and good afternoon to Blaise. Okay, so I think we need to wait for Casey, right, Blaise? All right, so it's great honor to to have you as our guest lecturer today, and I hope everyone will learn a lot from you and also from our content today. Okay, and everyone, if you have any question on this topic during our event, you can just write in the Q&A, also in the chat box. We will have some time to answer the question. Okay, good afternoon, Casey.
Good afternoon. I would just like to make a brief introduction.
Okay.
Mr. Blaise. Good afternoon, everybody. Good afternoon, Blaise Kolivas, for being here with us in Cambodia. Ladies and gentlemen, I would like to just give a brief introduction to our speaker today, our presenter, Mr. Blaise Kolivas. Blaise is a director at W Consulting, an independent financial reporting and corporate finance advisory and professional skills training firm. He is a chartered accountant and Johannesburg Stock Exchange accredited IFRS advisor. In our region, many of us don't know, but the Johannesburg Stock Exchange has a market capitalization of 1.14 trillion US dollars. Blaise heads W Consulting's IFRS advisory team and provides technical advisory services and training on IFRS, International Financial Reporting Standards. He is one of the leading experts in IFRS. And Blaise served for 2 consecutive 3-year terms as a board member of the South African Accounting Standards Board. And during his terms in office, he chaired the technical committee of the ASB and served on the operations committee of the board. He is currently the deputy chair of the accounting practices committee of the South African Institute of Chartered Accountants. Blaise, thank you very much for sharing your expertise with us. Ladies and gentlemen, I wish you all a wonderful afternoon and thank you for joining us here.
And thank you very much for that warm welcome and introduction, Casey. And once again, a very good afternoon to all of you and welcome to this IFRS update webinar. A very big thank you to CAMAT Business School for inviting us to speak this afternoon. And yeah, I guess you've already heard all about me, so I'm just going to say it's a great pleasure to meet you all virtually, although I can't see you, but you can certainly see me. And I do hope that over the next 3 hours, you will enjoy this IFRS update and find it informative and somewhat entertaining as a presentation on IFRS standards can possibly be. Over the course of the next 3 hours, we will be covering a couple of IFRS, recent amendments rather, to IFRS standards. We'll start off by talking a little bit about what the International Accounting Standards Board is currently working on by just looking at some of the key projects of the ISB's work program. And then we will talk about a range of IFRS amendments that have taken place over the past 20 months or so. Those of you that did attend the IFRS updates a little bit earlier in the year, in May this year, we covered 2 recent amendments which took place in respect of accounting policies, disclosure of accounting policies, and disclosure of accounting estimates. And the ISB has issued a number of other amendments over the past several months, and that's what our focus is going to be on this afternoon. Just to repeat again, for those of you that may have come in after the announcement was made, if any of you do have any questions regarding the technical content of what I'm busy discussing, please do send those in the Q&A box. And once my attention is brought to them, I'll pause it at various intervals and ask if anybody does have any questions and respond to any questions that have come in the Q&A section of the webinar. We will be taking a short little comfort break around halfway through the session. So I wish you all very well over the next 3 hours. The International Accounting Standards Board is currently working on a number of different projects, a series of amendments in progress that will add to and enrich the body of IFRS standards that we currently have with us today. For those of you who do monitor the IFRS standards and the developments in there over looking at the work that the International Accounting Standards Board does, would know that over the past, I'd say 10 years or so, we've seen the International Accounting Standards Board working on a number of major, what I call big bang standards. For example, the standard on financial instruments, which took place, which was developed over a period of almost 10 years. And of course, that resulted in a major new standard being issued with some changes that would impact many IFRS reporters or preparers of financial statements under IFRS standards. We've also seen a major new revenue standard, IFRS 15. We've also seen a major new leases standard, IFRS 16. And those of you in the insurance industry would also be familiar with IFRS 17, which is a standard that is about to come into effect from 2023. These major new standards that the International Accounting Standards Board has developed over the past several years certainly have taken a lot of the board's attention, both from a resource perspective as well as from a propaganda perspective, in terms of the attention has always been on these major new standards. But that's not to say that those are the only things that the board is working on. The International Accounting Standards Board follows a very rigid process called due process, or rather they refer to it as the due process. And this due process involves various phases of work. And every single project that the International Accounting Standards Board works on goes through this process. As you'll see from the graphic in front of you, the due process involves many phases. It starts off with the agenda consultation in terms of the request for information that the IASB publishes approximately every 5 years or so. And based on that request for information and that public agenda consultation process, the board then sets its work program, sets its focus for the medium-term period by prioritizing and allocating resources to the various projects that stakeholders have indicated are important for the board to focus its attention on. Once the board has set its agenda or has kind of defined its agenda, it's not cast in stone, it is flexible, and the board can realign priorities as needed should the need arise. But once the agenda has been set, the board will then allocate technical staff of the IFRS Foundation to research the various projects that they then are working on. And through the research phase of the board's work, the IASB will conduct research by publishing discussion papers, by publishing requests for information, by convening discussion groups and meetings around the world with local standard setters, with industry representatives, to get a global perspective on how to deal with the various projects that the board is working on. And this research phase is very, very crucial, because this is how the board identifies how to solve a particular problem that the board is working on based on the particular project in question. So that research program can often take a number of years in order to make sure that they have considered all possible angles to a particular problem that is under discussion. Based on the feedback that the research phase results in, the IASB will then set about developing an exposure draft of a proposed new IFRS standard or a proposed amendment to an existing IFRS standard. And that exposure draft is once again exposed for public comment. So the board will conduct outreach with its various stakeholders to understand whether the proposed final amendment or proposed final standard is going to achieve the objectives that the board has set for the particular project in question. Based on that feedback that the board receives, the response will either be that the majority of respondents agree with the proposals, and on the back of that, the board will then ballot for issuing the amendment or the new standard. And once that standard is issued, the board, that standard becomes law for anybody that reports using IFRS standards. To the extent that the feedback shows that the respondents are not happy with the proposals, or that they've identified certain problems or flaws with the requirements in the new exposure draft, that process will start again, and the board will go back and revise the principles and issue a new exposure draft, making absolutely sure that the final pronouncement has got the consensus, has got the approval and the consensus of the majority of respondents who have participated in the process. But once the final standard has been issued, that's not the end of the process, because the final standard will typically have a lead time before it becomes effective. So for example, if a standard was issued today, if an amendment to a standard was issued today, typically the board would then say, well, based on the significance of the changes, just how complex are the new changes, from what preparers are currently doing. And if the feeling is that it's not going to result in major upheaval, the board might set the effective date to be for years beginning on or after 1st of January 2022, which would be, the start of the next calendar year. In other cases, if the proposed new requirements are significantly different from what preparers have been used to, they might set the effective date for some time in the future. And that's what we saw with the major new standards, IFRS 9, IFRS 15, IFRS 16, and IFRS 17. Each one of those standards had a lead time before it became effective of, in some cases, 4 years, in other cases, up to 6 years, depending on the circumstances. So with respect to that, the board will then determine what is the appropriate timing of the new standard or the amendment coming into effect. That's not the end of the process, because once the final standard has been issued, or once the final amendment has been issued, it is likely that there will be some implementation challenges. We see that with the major new standards. We see that with, for example, leases, a standard which at first glance seems relatively straightforward in terms of the new requirements of IFRS 16. But there are a host of practical application challenges which need to be addressed. So we've seen requests to the IFRS Interpretations Committee, that is the sister body to the International Accounting Standards Board, that deals with implementation challenges and provides guidance either in the form of interpretations of IFRSs, IFRICs, as they are referred to, or as referrals back to the International Accounting Standards Board for amendments to be made to the standards, or in some instances where the IFRIC will provide explanatory guidance in explaining that, how a particular application challenge should be addressed based on the existing requirements within the standards, in the so-called agenda decisions that the IFRIC publishes. And I guess in some of the future courses, presentations, we'll be covering some of those IFRIC agenda decisions, talking about how they are relevant in helping with the application of IFRS standards. Of course, the IASB does also make minor narrow scope amendments, and many of the amendments that we'll be discussing in today's webinar come out of this implementation phase of the IASB's work. But every single amendment to a standard, even in this implementation phase, goes through this due process of research, of feedback, and of balloting before it comes into effect. Lastly, the post-implementation reviews of the IASB focus on reflecting on the successes of a major new standard. The post-implementation review typically arises anything between 3 to 5 years after a major new standard has come into effect. So we will see, for example, within the next couple of months, IFRS 9's post-implementation review is about to kick off. And that's where the board will then once again reach out to its stakeholders. Anybody that's listening in on this webinar is a stakeholder of the IASB. You wouldn't be interested in IFRS, well, you wouldn't be in this webinar if you're not interested in IFRS. And I guess from that perspective, if you have some kind of interest, either as a preparer of financial statements or as an auditor or a regulator or a user of financial statements or a student studying towards one of those roles, all of those roles make you a stakeholder of the IASB. So the board will then reach out to the stakeholders and ask, is the new standard working well? Is it achieving its objectives? Are there any areas where more guidance is needed? Is there a need for more clarity on a particular matter? And based on that, the results on the post-implementation review feed into the next round of agenda consultation and set the tone for the next round of the IASB's work. So as you can see, the process of the IFRS standards is a dynamic, ever-evolving cycle. And as we currently sit here today, listening in on the amendments that have happened in the past several months, the board is currently working on a whole host of other projects. Looking at some of the research projects in progress, the IASB is conducting research on a number of initiatives. Some of these are a little bit more advanced than others. What I mean by that is that some of these have gotten to the point where the results of the research are in, and the board is now ready to set about developing an exposure draft on the particular project. In other instances, the project has yet to even take off. So the board has added a matter to its agenda for research, but hasn't actually conducted significant work yet on that particular topic. And so that's only about to start in the next couple of months. Some of the major ones that I would like to just maybe draw your attention to, not that we're going to discuss them in detail today, but just to make you aware of them, given the fact that they are seen as being somewhat critical. In some instances, they fill a long-standing gap within the IFRS standards, given that there is presently no guidance on how to deal with some of these issues. And in other instances, it is of significance because of the controversy around some of the issues and the fact that the board is now going to have quite a task trying to please all the different views that have been expressed so far on the projects. I'm talking specifically about firstly, the business combinations under common control project, or BCUCC. That project has been it's been on the to-do list for quite a number of years. Ever since IFRS standards first came into effect back in the early 2000s, there has been no guidance within the body of IFRS standards on how to deal with such transactions. I'm referring specifically to a transaction involving one company acquiring control of another company, but whether that's control of another company or control of a business of another company, but effectively one company acquiring control of a business. And that business, before the transaction, that business was controlled by a particular controlling party or ultimate controlling party. And after the transaction, that business is still controlled by that same ultimate controlling party or intermediate controlling party, as the case might be. For example, if you've got three entities, A, B, and C. B and C are both subsidiaries of A. A is the ultimate controlling party. If A directs B to acquire the business of C, the business of C was previously controlled by A before the transaction, but after the transaction, the business of C is still controlled by A because A controls B, which controls C. So we have a scenario where the movement of A is under the same common control of A both before and after the transaction. And from that perspective, we have a business combination under common control. And right now, the IFRS standards, well, the most obvious one would be IFRS 3, the standard on business combinations, but IFRS 3 specifically says, do not account for business combinations under common control using the standard, which basically means that there is no guidance on how to deal with that transaction, and that such a transaction can actually occur very frequently. It happens in the listed company environment where you've got large groups that reorganize themselves. It happens in the family-owned business environment where you've got family-held businesses where it's the same family that controls all the different businesses down below, and they are simply moving resources between one pocket to the other pocket in the same pair of trousers. So currently there is no guidance on how to deal with these transactions, with the result that you've got inconsistent accounting policies being developed, because I'm sure you're all aware that where there is no specific guidance in the accounting standards, IAS 8, the accounting standard on accounting policies, requires you to develop an accounting policy of your own to deal with that transaction. But that means that out of the 433 people on this call, there are potentially 433 different possible accounting policies that could be developed because there's nothing specifically saying this is how it shall be done. And on the back of that, this is why this is such a very important project. The current proposals at this stage, although I must emphasize again, we're still in the research phase of the project, but the current proposals at this point are to to the extent that the transaction does not involve outside shareholders, to require the recipient company, the company that is acquiring the business, to measure the assets and liabilities acquired using book values, predecessor accounting, basically the book values of the entity, how the entity in question has been accounting for these things all along. Whereas to the extent that the recipient company has outside shareholders, in other words, the transaction involves non-controlling interests, to require those transactions to be accounted for using acquisition accounting, which basically means bringing on the assets and liabilities from the recipient's perspective at fair value. So these are some of the tentative proposals at this point, but it remains to be seen how the board evolves this project as the project continues over the next several months. Of course, once that has been completed, one of the future IFRS updates will discuss that in a lot more detail and understand the practical application issues around that new guidance. The other standard that I just want to mention in passing before we move on is goodwill and impairment. Now, this is also in the research phase. It is probably one of the more controversial discussions that I'm aware of in the past couple of years when it comes to IFRS standards, because it involves differing views on what to do with the goodwill that is recognized as the result of a business combination. So interestingly, both of these projects that I'm mentioning here deal with business combinations. But in this instance, we're talking about a regular business combination under IFRS 3, where the result of the acquisition accounting is that to the extent that the acquirer has paid more for the assets and liabilities than what they seem to be worth, the recognized assets and liabilities, the balancing figure is goodwill. Now, some years ago, I don't know how many on the webinar would recall this, but many years ago, goodwill was just another intangible asset that was amortized over a useful life. So at some point in time, the goodwill would eventually deplete, and the entity would recognize a portion of that goodwill year after year in the subsequent years after a business combination. And then in the mid-2000s or thereabouts, the IASB amended IFRS 3 to make it clear that goodwill shall not be amortized. Instead, goodwill takes on a unique feature. Unlike other assets that typically deplete over time or are depreciated or amortized over a period of time, goodwill is kept frozen, like a fly in amber. It's cast in stone, it's stuck there, and it remains at its original value as recorded when that business combination occurred. However, there's a requirement that for as long as that goodwill remains recognized on the balance sheet, that it be tested for impairment every single year, regardless of whether there's any other indicator of impairment, which again is unique because all other assets are only tested for impairment where there's an indicator of impairment. So these are some peculiar aspects around the goodwill. And based on the post-implementation review that the board conducted on IFRS 3, just linking it back to my earlier comment, to understand how companies are responding to and dealing with some of the requirements of major new standards. So once the board amended IFRS 3 and required goodwill to be treated this way, the board has conducted research to understand whether stakeholders are happy with that result, whether there's room for improvement, whether there's a need for more guidance. And the feedback that the standard setters have received is that there's a strong demand, a strong pull for a reintroduction of amortization. Although the IASB's preference is to not introduce amortization because there was a reason why it was scrapped originally, because the board felt that it became an arbitrary exercise to determine a useful life. It didn't add information to the users of the financial statements. And so the thinking at the time was that amortization was not appropriate. The board still believes that, but is hearing the call that many respondents are arguing that amortization should be reintroduced, because the contra argument is that if I had a business combination that I paid for 20 years ago, can I say that the synergies, that the workforce, all the things that went into my decision to basically pay for the goodwill, can I say that those factors are still present 20 years later? There's a very good chance that any perceived goodwill at the time has been depleted and has been subsequently replaced by internally generated goodwill after the acquisition of that business. Others still acknowledge the fact that at determining the useful life of something like a workforce, or determining the useful life of a reputation or something like that, which you cannot necessarily define more discreetly, becomes challenging. And for that reason, there's an argument to retain the current status quo of not amortizing goodwill. These are the contrasting views, and this is what the board is currently debating. And I guess the votes seem to be very narrowly split, but we'll see what the outcome of the process is. Other arguments are that the current requirements to have a mandatory impairment test rather every single year is onerous, and many are calling for an introduction of an indicator approach to impairment. And some are also calling for additional disclosures around goodwill. For example, a requirement for management to report back on how it's monitoring the performance of goodwill as a result of an acquisition that occurred in the recent past. So these are some of the proposals, and I'm sure that many of you have your particular viewpoints. Some of you might favor amortization, others might not. Others might favor an indicator approach, others might favor a mandatory impairment test every single year. So these are some of the issues that are currently being discussed. And as I said, the results of this will be quite significant for companies that do recognize goodwill in a business combination, because it's likely going to change the landscape going forward. I see a comment from Casey, an indicator approach sounds reasonable. I certainly do support it as well, but it remains to be seen just how that indicator approach would work in practice. Those are some of the finer points that need to be discussed before the board sets an exposure draft on it. I'm not going to talk about some of the other projects. Some of them have been a bit more advanced, but they've been paused for the time being. For example, dynamic risk management, it kind of started, there was a discussion paper, they've stopped it, and it'll kickstart again in the coming months. Similarly with extractive industries, and then of course the post-implementation reviews of IFRS 10, 11, and 12, and IFRS 9 on financial instruments are about to take off. But as these projects evolve further, we'll update you in future IFRS updates. The standard setting projects, these are now a little bit more advanced, of course. We now have gone through the research phase, and the board is now either setting about developing an exposure draft on how a final standard might look. And others are, sorry, I am seeing a couple of hands going up. If those hands relate to questions around anything that I'm saying, please remember that if you do have a question, to submit it in the Q&A box, and I will respond to any questions that come in via that platform. I see a question, can we do amortization on goodwill? The answer is no, not under full IFRS, only under IFRS for SMEs at present. But this is one of the things that the IASB is proposing to see whether full IFRS should allow it going forward. These standard setting projects, some of them we have an exposure draft already out. In other instances, we are expecting an exposure draft imminently. In some instances, the exposure period has ended, and we are now waiting for the feedback on the exposure draft to result in a final IFRS standard. And we spoke about some of these in the May update when we spoke about the IASB's better communication project, where the board is looking to revise the layout of the primary financial statements by introducing a more discrete sections around the company's financial performance. Once again, I'm not going to go into too much discussion at this point. I think it's more just for noting. What I would maybe suggest, though, that to the extent that any of these projects relate to areas where you have a particular focus area, to visit the IASB's website, ifrs.org, and to follow the projects and to participate in the process where the IASB has asked for commentary on any of these proposals, to send through a response to a comment letter and to provide the feedback so that the IASB can take that feedback on board and consider it in the development of the final standard. I can tell you as a former standard setter myself that the IASB does follow and look at all of the feedback that they receive, even if it's just for noting, and you'll be surprised just how often a single exposure draft comment letter could have an impact in terms of the development of a final standard. Just lastly, then, a couple of maintenance projects that are more just for noting. Now, these are very specific, very narrow issues that the board is currently looking at. And in some instances, you may or may not even notice any impact as a result of these, because they are there to fix certain issues around implementation. For example, the IFRIC, the Interpretations Committee, may have referred a particular matter to the board because there was an identified problem with a particular standard that has now been repaired or fixed. And as I mentioned earlier, that many of the amendments that we'll be looking at over the course of this afternoon's webinar have come out of this maintenance phase of the board's work. So once again, as these projects are completed, we will incorporate them in future IFRS update discussions. The other projects that the board is working on, these kind of fall outside of the 3 phases that I've mentioned so far. You'll recall when I started my introduction to the life cycle of the ISB's work program, I mentioned the agenda consultation. 2020 was actually supposed to be an agenda consultation year, the 3rd ever agenda consultation ever since the board started with this process back in the early 2000s. The idea here is that this is where the board then reaches out to its stakeholders to say, right, we have identified certain issues that we think we need to address, and they may have come from implementation requests, referrals from the Interpretations Committee, the results from the post-implementation review of the last cycle, or just current economic, macroeconomic developments around the world. And on the back of that, the board will then say, right, these are some of the things that we think we need to discuss. Do you agree that we need to discuss them? Or do you believe that perhaps there are other priorities that we should look at? Or out of the things, if you are in agreement that we need to discuss all of these topics, which ones are more urgent and which ones are less urgent? So for example, some of the things that they are proposing for discussion are how to account for cryptocurrency. Because right now there's no real definitive guidance on how to deal with cryptocurrency, which is an emerging issue globally. And various local standard setters have come up with proposals. The Interpretations Committee gave very high level guidance in one of their agenda decisions, but it's not definitive. And given that this is something that is evolving and becoming more real around the world, it's something where one would expect that some more precise defined standard setting would be welcome. Other examples are standards dealing with high inflation. Right now, we do have a standard that deals with hyperinflation, IAS 29, but there's no standard that deals with high inflation. And while the lines between high inflation and hyperinflation may be a bit blurry as as an economy transitions from one to the other, there are some unique reporting challenges where an economy operates under high inflation while not necessarily having gone over fully into hyperinflation. So the board is proposing to do some work there. Other notable areas where one might consider that guidance is welcome is areas around emission trading schemes, dealing with carbon credits and things like that. So these are some of the topical emerging issues that the board has proposed may be addressed subject to available resources, and they are looking to you as stakeholders to provide guidance and feedback to them as to whether or not to deal with these issues and how to prioritize them. I mentioned that 2020 was supposed to be the 3rd agenda consultation, but that process was delayed last year due to the COVID-19 pandemic. And so the request for information was only issued in March of 2021, and comments are due by the end of September. So as of today, we have a little over 11 days left before that process closes. That's not to say now that we've missed the opportunity, but it just means that any other new issues that come to the fore will have to go through a slightly different process to come onto the work program than by coming in through the agenda consultation. But the results on the agenda consultation will likely feed into the board's focus for the next 5 years, for the medium term. And then lastly, on the taxonomy updates, the ISB conducts a side project, I guess, in maintaining a taxonomy for XBRL purposes, extensible business reporting language purposes. Now, XBRL is an emerging requirement around the world. It's a form of electronic communication of financial information. And by electronic communication, I don't mean printing the financial statements out of Excel into PDF and attaching the PDF to an email and sending that off. That's electronic communication, but that's not what XBRL is all about. XBRL is about tagging information with certain, I guess, almost like a hashtag for social media purposes, whereby those hashtags can then be imported into a XBRL reader, and that will allow then a user to analyze and absorb and consume those financial statements using more dynamic processes where one can then align and compare certain pieces of information by making use of this format of financial statements analysis. So increasingly, more and more jurisdictions are moving towards an XBRL platform. I'm not sure how that has played out in Cambodia to date, but certainly it is taking off around the world. The IFRS Foundation, through the ISB, is driving or assisting that process by developing a platform of XBRL structures or tags called a taxonomy, which are aligned to the disclosure requirements of the IFRS standards. So as new standards are being issued with new disclosure requirements, the taxonomy of those requirements changes slightly. And so this is almost a parallel process to the standards themselves. So as a new standard comes out, the taxonomy updates to align those hashtags for XBRL purposes to the new requirements. So as you can see, there have been a number of amendments in the recent past relating to that. And then lastly, just a side project of the IFRS Foundation. So now I'm using a different name here. The ISB is part of the IFRS Foundation. So you've got the IFRS Foundation at the top that appoints and monitors the ISB's work. The IFRS Foundation appoints the IFRS Interpretations Committee. And the IFRS Foundation is responsible for spreading IFRS around the world by getting governments and jurisdictions on board to adopt IFRS in different parts of the world, by creating awareness of the importance of IFRS standards and so on and so forth. What the IFRS Foundation has done recently is published a consultation paper on sustainability reporting to understand whether there's an appetite and a demand for a development of global sustainability standards. So sustainability reporting is becoming more and more prevalent in different parts around the world. There are different bodies that set sustainability standards and best practices and things like that. But currently there's no single, I guess, authorized body that sets sustainability standards following a formal due process that has the buy-in of jurisdictions around the world. So what the IFRS Foundation is saying is there is a linkage to a certain extent between financial reporting standards and sustainability reporting standards, even though the ISB is not responsible for setting standards on sustainability issues. The Foundation's proposal is to set up another standard setting body using or leveraging off the experience that the Foundation has around international standard setting and taking some best practice, things like relevance, things like materiality, things like all of those concepts around standards that accompany the IFRS standards, and using those principles as a way of setting globally accepted sustainability standards for reporting purposes. So what the proposals here are to develop or to establish a sustainability standards board, which would be modeled along similar lines from a governance perspective and standard setting process as the ISB. The initial focus on these standards would be on climate related issues, but potentially extending to other social issues and other related matters. And based on that, then using the results of that to go to various to go to various jurisdictions and governments and say, look, if there's a requirement in your jurisdiction to report on sustainability issues, why not make it a requirement to follow sustainability, our sustainability standards? It'll be interesting to see how this plays out, but given the interactions between financial reporting and sustainability issues, I would expect that this is something that will become part of the financial reporting of the future, not just limited to financial statements, but financial reporting in total. I see a comment here from Kim. I have found some institutions publish the report, ESG and Climate Change Report. Indeed, there are various institutions that have done their own work and published their own guidance and best practices, and in some cases they might even call them standards. I guess what we're saying here is, rather than having each institute doing its own things and having inconsistency, because we could have had that with accounting requirements as well, accounting standards, by having a single global body that people have trust in terms of their impartiality, in terms of their due process and so on, and governance, that we can then make these global standards mandatory, rather than having to rely on various guidance coming from various institutes and self-appointed standard setters. But let's see what the outcome of that is. It remains to be seen whether that is something that the world takes on. I'm going to pause for a moment. Just the question mark slide indicates the conclusion of this section of the presentation. But just a reminder again to anybody that may have tuned in more recently, is that if anybody does have any questions, to please send those questions through in the Q&A box. And as my attention is drawn to those, I will certainly stop and respond to any questions that come in. I see some of you still have your hands up, but I'm assuming that maybe you just left them up. But if the hand is up for a question, please send the question through in the chat pod. Right, then let's move across to the next topic for today's webinar, and that is the amendments to IAS 1, dealing with the classification of current liabilities. Now, if you attended the IFRS webinar in May that I presented, where we spoke about the presentation of financial statements, you'll recall one of the questions I asked at the time was what comprises a complete set of financial statements. And I explained to you that IAS 1, the standard on presentation of financial statements, defines a complete set of financial statements as comprising 4 primary statements. We've got the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, and the statement of cash flows. And then we've got the supporting notes. And the notes then provide the additional explanations around the accounting policies, which we discussed in May. It contains the disclosure requirements of the various standards to the extent that numbers aren't reported on the face of the primary statements, and any additional disclosures around things like judgments, risk disclosures, and so on and so forth. Our focus today is on the statement of financial position, also known as, or formerly known as, the balance sheet. The balance sheet contains our assets, our liabilities, and our equity balances. And that will effectively, or the sum of all of those items, or I guess the deduction of the one from the other, but basically the net position of the statement of financial position is your net asset position, which is why the description is perhaps a bit clearer and a bit more precise than the old balance sheet, even though many of us still refer to it as balance sheet, which is perfectly acceptable, by the way. It doesn't matter if you call it balance sheet, as long as you don't confuse the users. So just make it clear what that document contains. Nevertheless, within the statement of financial position, within the balance sheet, IAS 1 says that all assets and liabilities must be presented on a current and non-current basis, unless a liquidity basis of presentation provides more relevant and more reliable information than a current non-current classification. So what this basically means is, unless you are one of the few entities where a liquidity basis would provide better information, for example, well, before we move on, let me explain to you under what circumstances a liquidity basis would provide more relevant information. That's typically where you as a business do not have a clearly defined operating cycle. So what I mean is, most retailers, for example, let's just start with that example. The retailer will typically say, well, there's a period of time from when I buy my finished goods that I'm now going to sell to my customers. So that from the point at which I spend the money to buy the goods, I market them for a period of time within my store. I then sell goods, in some cases for cash, in some cases for credit. And then from the point at which I sell the goods and until I've collected the money from the customers for any credit sales, my operating cycle is very clearly defined, both from when I pay for the goods or services that I've received to when I've received cash for the goods or services that I've supplied. And based on that, some companies may have an operating cycle of a number of days, a couple of weeks, maybe a couple of months. In some cases, the operating cycle may be a couple of years. For example, in the forestry business, from when you plant your seedlings in your plantations until those trees have grown to the point where they are then cut down and then produced further and sold and so forth, that period of time may take a number of years. But once again, the cycle is very clearly defined. But then there are some companies, particularly investment entities, financial institutions, things like that, where your operating cycle is not very clearly defined. And from that perspective, a liquidity basis would then be more appropriate rather than an artificial 12-month period, just because 12 months is a default position. Then on that basis, a liquidity basis is typically seen as being more relevant for the users. And all that basically means is that you sort your assets and your liabilities in your balance sheet from the most liquid to the least liquid, or vice versa, from the least liquid to the most liquid, and make it clear to your users of your financial statements how you've prepared your financial position disclosures. The majority of companies, however, do have a clearly defined operating cycle. And for that reason, we are probably most familiar with seeing the current, non-current classification. And that basically means that you will see a very clearly defined separation between the non-current section and the current section. In some instances, a single item might be split between a current and a non-current portion, depending on the circumstances. And I'll highlight that as we go through the next couple of slides. The way in which we determine whether an asset or liability is current or non-current is based on two definitions within IS1. IS1 defines current assets and current liabilities, and by implication, anything that is not current must be considered non-current. That's how non-current is defined. A non-current asset or a non-current liability is any asset or liability that is not current. So starting with the first definition, a current asset is any asset that is expected to be realized in or intended for sale or consumption in the entity's normal operating cycle. What that cycle is remains to be seen. As I said, that would be an entity-specific assessment of what your normal cycle is. But if it's expected to be realized in or intended for sale or consumption in your normal operating cycle, by implication, that is a current asset. So in my earlier example of the forestry plantation, those forestry plantations, which might actually have a life cycle of a number of years, would still be presented as current assets because they are intended to be realized in the normal operating cycle of that business. Any asset that is held primarily for the purpose of being traded is a current asset by definition. Any asset expected to be realized within 12 months after the reporting date, assuming that your cycle differs from the 12-month period, that would mean that anything that's expected to be realized within the next 12 months is also considered a current asset. And any cash or cash equivalent asset is a current asset by definition. And as I said, anything else that is not current must be considered non-current for the purposes of this. So for example, if I have a long-term receivable, if I've advanced a loan to another entity over a 5-year period, and that loan is repayable in installments of monthly installments, then any installments that are expected to be received within the next 12 months are my current portion of that loan, and anything beyond that is non-current, which is why I say you could have a split between a current and a non-current element, which often happens for financial instruments. Moving across to the definition of current liability, a current liability similarly follows the same process as with the previous slide. There's 4 examples of a current liability, and anything else is non-current. So when we look at current liabilities, any liability expected to be settled in the normal operating cycle, which mirrors the point on the previous slide. Any liability held primarily for the purpose of being traded, again, just the reverse of what we saw on the previous slide. And any liability due for settlement within 12 months is a current liability. But then this last bullet point is interesting because that's different, very different to any of the points on the previous slide for current assets. Any liability for which the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting date is a current liability by definition. So that means that if you do not have an unconditional right to refuse payment within the next 12 months, that liability or portion thereof must be classified as current. That point goes on to explain that terms of a liability that could, at the option of the counterparty, result in settlement by the issue of equity instruments does not affect its classification. And all that was saying is, if I've got a liability that can be settled either in cash or in me issuing my own equity instruments in settlement of that obligation, the fact that I might not actually have to dig into my pocket and pay over cash doesn't affect whether this is a current or non-current liability. The fact that settlement may be in shares is simply saying that the currency of settlement could either be in cash or in shares, but we look to when settlement is required to determine whether it's current or non-current. So this is independent of the recognition and derecognition requirements of the individual standards that govern the liability. It's independent of the method of settlement. What it comes down to is, when is settlement due? Or, put differently, to what extent can I delay settlement beyond 12 months? Because if I can't delay settlement beyond 12 months, then I do not have then I have a current liability rather. It's this last bullet point that became problematic for many companies. Many companies have had challenges around this last bullet point, particularly as economic conditions deteriorate. And as we've seen now with the global pandemic and the impact that that has had on global markets, this has been a bit of a challenge, which is coincidental because when this amendment came out, it actually preceded the global pandemic, at least the worst of it, the outbreak of it. But it's become very relevant in the current environment. Challenges arose where, for example, a company may have had well, firstly, let's look to intragroup liabilities. Intragroup liabilities where you've got a loan that's been advanced from one entity to another company within the same group. You would have had a situation where these are often, there's no contract, there's no fixed terms of repayment, they're interest-free, not that that affects the classification, because none of these talk about whether it's interest-bearing or not. It comes down to when is settlement due. So in the absence of a defined point that says settlement is due on a particular date, then this becomes problematic, because the implication is that a loan with no repayment terms presumably means that the loan can effectively be called upon on demand, or rather, put differently, the borrower has no unconditional right to defer settlement beyond 12 months, which would render that to be a current liability. And very often these group loans involve arrangements whereby a company depends very much on these group loans. They very often serve as a very permanent source of funding, of financing for that, or capital for that company, and yet they would have to be classified as current liabilities according to this definition. Another problem arises in a situation where a company has a loan that is repayable in installments over a number of years, but to the extent that there's default on any single installment, the entire loan becomes repayable on demand. And as a consequence of that, the question then is, if I don't have an unconditional right, can I classify that instrument as a current, well, as a non-current portion, given the fact that there's a condition attached to it? So this is where the IASB had to come in with the amendments under discussion here to amend this last bullet point to provide more clarity as to when would a liability be classified as current and when would it be classified as non-current. The revised definition of a liability now reads as follows. And as you can see, the focal point of the amendments is on that last bullet point. The markup that you see on the slide indicates the changes that were made. So we have new words that have been added in and old words that have been deleted. Firstly, you can see that the words unconditional have been deleted. And I'll talk about the significance of these changes in a bit more detail in just a moment. We now have added word in to confirm that the right must exist at the end of the reporting period. And that last sentence in that paragraph, terms of a liability that could at the option of the counterparty result in settlement by the issue of equity instruments to not affect the classification, that's been deleted from that paragraph, but it's been moved into another section that now talks to all of the bullet points, because as it was originally positioned, the implication was that it was only relevant to that fourth bullet point. But that's now moved to now confirm that any liability or classification of any liability is not affected by whether or not equity instruments would be settled. So any of these other liabilities would likewise not be affected based on whether or not we are dealing with equity instruments in settlement of the obligation. So let's talk in a bit more detail about these changes and understand the significance of these changes. Firstly, what is the right to defer settlement for at least 12 months? The right to defer settlement for at least 12 months must be a substantive right of settlement. And the settlement of that, liability must be, or rather the right to defer settlement of that liability must exist as at the end of the reporting period. The old definition was not explicit on that particular point. So let's understand what it means to have a right of substance. A right of substance means that it's a right that can be legally enforceable, can be enforceable in practice. If a right of deferral exists, but it's based on an understanding that isn't enforceable in a court of law, then on that basis, it has no substance. We have other scenarios where a company may have a perceived right because a counterparty has chosen not to exercise its rights in respect of demanding payment. So for example, if I had a loan that was repayable over 5 years, and the loan fell in default at some point during the year, and the counterparty has simply just not come to do, in the event that there's default, the counterparty has the right, the legal right to demand repayment of the loan in full, immediately on demand. The counterparty has chosen not to exercise its rights for a couple of months. Now, the question is, does the fact that the counterparty has chosen not to exercise its rights to demand repayment mean that I have a right to defer settlement beyond 12 months? One might argue that, yes, there might be a right there, but it's not a substantive right if that right would not stand up in a court of law, if the matter was went to a court for arbitration or in a court case. So from that perspective, we would contest that that would not be a right of substance. And on that basis, then, if that was the point at which you were going to classify the liability as non-current, that would mean that you would have to classify the loan as current based on the discussion here. The standard goes on to explain, or the additional guidance that has come in to explain, is that the right must exist at the end of the reporting period. The old standard didn't quite explain it. So there were circumstances where a company may have been in the process of preparing its financial statements, and it became apparent that after year end, there was new information that came to light that confirmed that the company had a right of deferral. But if that right of deferral did not exist as at the reporting date, then that would be an example of a non-adjusting event, just to link it back to IAS 10, the standard on events after the reporting period. By introducing this requirement explicitly in the definition, it closes the debate on whether or not a subsequent granting of a right is sufficient to affect the classification of the liability for presentation purposes. I'm going to pause the discussion for just a moment because I'm seeing a lot of commentary coming in both the chat and in the Q&A around the sustainability reporting standards. Folks, at this stage, this is just a thought. At this stage, the IASB is working on, or not the IASB, the IFRS Foundation is proposing to introduce a standard setter. That standard setter still has to be constituted, and that standard setter then still needs to set about setting standards before they come into effect. Around the world, regulators and jurisdictions around the world then need to mandate the use of those standards for them to have any legal effect. So we're still a far way away from sustainability standards developed by the IFRS Foundation coming into effect. How sustainability reporting elsewhere in the world works in terms of other guidance notes and standards that have been developed, that's outside the scope of the discussion here. So I'm not going to comment on that, but we're talking about standards that are, or rather a proposal to introduce a new parallel body of financial reporting standards, not around financial statements, but rather around sustainability reporting. I see a couple of other questions as well. Okay, some other comments. I feel the sustainability report should be part of the annual report, but not as part of financial reports. That's fine, and I agree with that. It's not going to be part of the financial reports, but to the extent that a jurisdiction requires a sustainability report, it would be part of the management commentary. It would be outside of that. A comment from, I think some of the challenge is knowing what are the relevant information the users of the financial statements really want in sustainability reporting. I'm not going to comment more on sustainability reporting at this stage, given, as I say, that this is still early days, but this is something that the IFRS Foundation is working on. A question around current and non-current liabilities from Kim Tevin. What about the bond that's embedded in a puttable option? How to disclose current or non-current? Folks, the classification of current versus non-current is not driven by the requirements of the individual standards. It's driven by IAS 1. So if you have a liability, you need to apply the liability against these definitions that we're talking about to determine whether it's current or non-current. If that liability represents an embedded derivative, and that's been separated from the host contract, then you apply the principles that we've discussed to the separated component to determine whether it's classified as current or non-current. The fact that it's a derivative does not make it automatically current unless it is one of those 4 conditions to be classified as a current liability. So unless it's repayable on demand, unless it's something that is held for trading purposes or due for settlement within the next 12 months, chances are that it's not going to be a current liability. I see another question that came in was from expected credit losses. Expected credit losses are not liabilities, they are valuation adjustments. So the classification of current or non-current is not relevant here. It is driven by, your classification of the receivable will be affected by whether the receivable is current or non-current, and the ECL will be a part of that. Whereas provisions from an IAS 37 perspective are driven by the definitions that we've spoken about over here. And from that perspective, any provision, any liability is subject to the same 4 criteria, regardless of the nature of the liability. If you have a liability, you apply these criteria that we're talking about here. I think I've gone through all the questions relating to the discussion around current versus non-current. So back to the discussion around the deferral rights. If you have determined that you have a deferral right as at the end of the reporting period, then that liability must be classified as non-current, because let's just go back to the wording in the definition. Okay, the way the definition is structured, if you have one of these 4 conditions, then it is current. If you do not have one of these 4 conditions, then it is non-current. So if you do have a right of deferral as at the end of the reporting period, by definition, it is not current, which means it must be classified as non-current. And so the updated or the expanded wording within the standard confirms that having the right at the end of the reporting period means that the liability must be classified as non-current, even if it would otherwise be due within a shorter period of time. Whereas if there is no such right of deferral, then you do not consider the potential to refinance the obligation, and you would classify the liability as current. Management intention or expectations are irrelevant for the classification purposes that we're discussing here. So if it is likely that the entity, if it's unlikely that the entity will exercise its right to defer settlement, that means that you would still classify the liability as non-current, but you may need to provide additional disclosure in the financial statements to explain that fact. So you'd have a non-current liability on the face of the balance sheet, and in the disclosure notes, you'll have a footnote somewhere explaining that, notwithstanding the fact that this liability is classified as non-current, management has classified it as non-current because of the deferral rights, but management does not expect that those deferral rights will be applied. Providing useful information to the users to understand that the deferral right exists, but these are management's intentions. but not allowing management intentions to affect the classification of the liability. So examples of events that could lead to additional disclosure: refinancing a liability classified as current on a long-term basis, rectification of a breach of long-term loan that was classified as current, the granting by the lender of a period of grace to rectify a breach of a long-term loan arrangement, and the settlement of a liability that was classified as non-current within a shorter period of time. Again, this is highlighting the fact that in spite of the classification of the liability as either current or non-current, the outcome turned out to be different. If the liability is or if the right of deferral is subject to certain conditions, then the right exists, the right has substance only if those conditions have been complied with as at the end of the reporting period. You'll recall one of my earlier examples I gave was of a 5-year loan where the loan is repayable in installments, but during the year, one of the installments was missed, and as a result, that default led to the entire balance becoming repayable on demand. So under those circumstances, we are not in compliance with the conditions to have the right to defer settlement beyond 12 months, which would mean then that the liability would have to be classified as current. If we are in compliance with the conditions as at the end of the reporting period, in other words, we are not in breach, we have not defaulted on any of the payments as at the end of the reporting period, then our right to defer the settlement of the remaining installments of that loan exists as at year end, is substantive because we are in compliance with the condition, and on that basis, then we would classify the remaining installments as non-current and only show the 12 months installments that are due within the next 12 months as the current portion of that loan. And so this confirms, this is one of the reasons why they had to delete the word unconditional, because very often a right to defer settlement is conditional upon compliance with conditions. But if you are in compliance with those conditions, then that would be sufficient to classify the liability as non-current. And then just to remind you once again, that last sentence on the definition, which I said was deleted, has been relocated to confirm that settlement in cash or in shares does not affect the classification of the liability. It's around when is settlement due rather than what the form of settlement or mode of settlement is. I see a question here came into the chat. The contract to repay the loan, which is not state the date of repayment, can then classify as non-current liability. I guess this goes back to the comment I made earlier in one of the examples. I'll repeat my point on that to say, if you have a loan in which no repayment date has been specified, you would need to establish what are the legal implications of that. If no repayment date has been specified, does common law or is there a law in the country that talks specifically to this? Is there a principle that says that in the absence of a repayment date, the borrower can defer settlement unconditionally, well, not unconditionally anymore, but can defer settlement beyond 12 months? If legally that right exists, then yes, potentially you could end up in a situation where that loan could be classified as non-current. But bear in mind that comes with measurement issues, because then you would need to discount the carrying amount of that to its present value for recognition purposes. If the legal interpretation is that in the absence of no repayment terms, that the amount is effectively repayable on demand, then that would mean that you would have to classify it as current because there's no right to defer settlement beyond 12 months. A follow-up question has come in, but can we then classify it as an equity item? You can only classify something as equity if there is no obligation to settle in cash at all. And that means that, again, it would come down to an assessment of the legal position as to whether or not you could refuse to ever redeem or settle at any point in the future indefinitely. If that's the case, then by definition, it's equity. If redemption has to happen at some point or can happen or can be forced by the lender rather, then it's a liability by definition. And then it falls back to this discussion of how do we classify as current or non-current. Right, let's look at a couple of additional questions. case studies before we move on to the next section. Those of you that do have your mobile devices handy, please do participate by scanning the QR code over the next couple of slides. Well, scan the QR code now, and the next couple of slides will change the poll for you if you're familiar with working with Poll Everywhere. If you do not have your mobile device handy, please open a browser window on your computer or device and type in the address pollev.com/goldenwindow397. That will allow you to participate in the poll using the browser instead of using your QR code to open the link. This is the same link that will be used for all of the upcoming quizzes. So please do keep the window open so that you can participate in each one. You don't have to keep scanning every single time. In the first question, we have a company called Bamboos. And they borrowed $1 million from a finance house repayable on the 31st of December 2020. Bamboos intends to approach management of the finance house to renegotiate the facility to extend payment until 2025. Bamboos management have it on good authority that the finance house will extend the facility, and they meet with management on the 5th of February 2021 to sign the extension to 2025. The question here is, how would you classify this liability, as current or non-current, assuming a reporting date of 31 December 2020? So for all of these quizzes coming up, we have the same year end, December 2020. So all of them are with reference to the same date. While this question's running, while I see the results ticking over, I see another comment from Vuth in the chat. The outstanding principal of the loan shall not be a committed facility, and it shall therefore be immediately due and repayable by the borrower in whole or in part at the option of the lender. It sounds like you've copied that straight from a contract, but based on that clause, should this be classified as current or non-current? I think you've answered your own question. The entire amount is repayable at the option of the lender whenever the lender decides to exercise that option, which means that the borrower does not have the substantive right at any date to defer settlement beyond 12 months, which means that the loan should be classified as current based on my understanding of what you've pasted here. Right, I see that the numbers are increasing steadily. I'm going to keep going for another minute or so before we move on to the next question. Right, see the numbers are ticking more and more slowly. It's kind of like popcorn in the microwave. When you hear that the popping stops, or when it starts popping very slowly, it means it's done. So I'm going to move over to the results and let's see what the responses have yielded. So out of the responses, as at the end of the reporting date, 40% of you have said it should be classified as current, and 60% of you have said that it should be classified as non-current as at the reporting date. In this instance, the minority have the correct answer, because as at the end of the reporting date, that liability was due for settlement on the reporting date. It was actually due for settlement on the 31st of December 2020, and it was not yet settled. The fact that management was approached the finance house, the lender, early in the subsequent year, they met with management on the 5th of February. They may have had it on good authority that the bank was willing to extend the facility, but that only happened, that right to defer settlement only happened in February of 2021. And that means that as at the end of the reporting period, Bamboos did not have the right to defer settlement, did not have a substantive right that existed at the reporting date. And on the basis of that, I would say that this is a current liability. You can't infer or impute what you think will happen because that's not a substantive right that existed as at the end of the reporting period. To be a substantive right, it must be legally enforceable on that date. And on that date, Bamboos could not stand up in court and say, on the basis of this agreement that's legally binding, I do not have to pay this amount within the next 12 months. For that reason, it's current. Let's look at the next quiz. Bamboos has a loan with Greenbank for $3 million that is repayable in 2025. The loan has covenants that Bamboos breached in June of 2020. Management meets with the bank in January of 2021, and the bank agrees not to demand payment of the loan for the next 24 months and to then reassess the loan. Remember, for the purposes of 31 December 2020, how should this loan be classified? I see that the responses have been going a bit slow here. Maybe I can elaborate further for anybody who's struggling with this one. My assumption is that by breaching the loan covenants, the entire amount becomes repayable on demand. So on the back of that, how would you classify this loan for the sake of reporting as at 31 December 2020? Okay, it looks like my popcorn is almost ready. Let's look at the responses. Oh, this one's even closer. This one is 45% have said that the loan is classified as current as at the reporting date, and 55% have said it is non-current. Now let's just go back to the principles that I explained previously. This, or rather deferral of the subsequent payments through to 2025 is conditional upon the loan not being in breach of the covenants. We are told that the covenant was breached in June 2020. We are told that, well, the assumption is that, I guess it's implied in the fact pattern, that the bank has not enforced its rights as at year end or up to year end. And subsequent to year end, they meet with the bank and the bank agrees to not demand repayment for the next 24 months and to then reassess the circumstances. So the right of deferral has only been reestablished in January of 2021. Prior to that, the bank had a right to demand settlement of the loan at any point in time, given the breach of the covenants that occurred prior to year end. And on the back of that, again, to have a substantive right of deferral means that the right must exist as at the year end. The fact that the bank has chosen not to exercise its rights does not mean that the borrower now has a right to defer settlement. That right could be changed with a new bank manager that came in on the last day of the year and said, right, call up all of the loans that are now in breach. And that would have meant that the borrower had no right to defer settlement. So from that basis, I would say that this is a current liability. Once again, I side with the minority position here. Third question. Bamboos has a loan with Blue Bank for $10 million that is repayable at the end of 2020. In November 2020, the Blue Bank agrees to allow Bamboos a grace period of 12 months for repayment of the loan with no right to demand payment at that time. How would we classify this liability? I see a question has come in. I guess it refers to all of these. The reporting date is referred to end of year, right? That is correct. The end of the calendar year, 31 December, is our reference to the reporting date for the purposes of these case studies. So we are working with a reporting date as at 31 December 2020 in all of these scenarios. Just a reminder, you can connect using the same link that we've been using for all of the case studies and the same code that was scanned originally. So just keep the window open and you can respond to each of the quizzes as they come up. A question has come in, is it 12 months from December? Well, I guess that's now where we would need to, that's part of the trick to this particular question is a matter of interpretation and I guess understanding the fact pattern. So this is one of the areas where I, as an IFRS advisor, need to ask additional questions in order to confirm the answer. I'm going to give the two positions. I see that the responses haven't increased significantly over the past couple of seconds. So I'm going to assume that those who have voted or plan to vote have voted. Oh, I've got, there we go. So let's look at the two positions and I'll go back to the question around 12 months from December. So the answer here is, again, quite finely split between current and non-current, 54% and 46% respectively. On this one, I'm going to say that the answer is it depends. And there wasn't an option for it depends, but it depends on what we understand by the right to defer settlement. If the payment was due at the end of December 2020, the reporting date, the year end, and already before we reached that due date, the bank agreed to defer for 12 months from the date that it was originally due, then I would support the non-current position because they are giving us an extra 12 months from year end, which means that we have a right to defer settlement for 12 months from the end of the reporting period. If in November, the right was for 12 months from November, then that means that the amount becomes repayable by November the following year. So with reference to the reporting date of end of December, then that's still within the 12-month period, in which case I would support the current view. But for those reasons, that's why I would support current or non-current if it was for those reasons that I've just given. So this one, I think, was one of those where it depends on understanding the specific fact pattern to be able to answer it appropriately. But I've given the two correct answers. If the view was that it was 12 months from December, then it is non-current. If it is 12 months from November, then it is current. Right, then let's move across to the fourth quiz. Bamboos has a loan with Yellow Financial Services. The loan is repayable in full in 2025. Bamboos intends to repay the loan in June 2021. How would we classify this as at December 2020? In response to a question that came into the chat, according to the IFRS, if repayment is within 12 months, should be classified as current. I don't know if that's a question or a statement, but yes, absolutely. That is what all of this has been about. Right, let's look at the results. In this instance, we have, okay, this is the first quiz where we've got quite a distinct dichotomy between current and non-current. 30% say current, 70% say non-current. Let's just go back to the principles that we've spoken about. They have a right of deferral in 2025 through to 2025. The fact that they intend to settle earlier doesn't change the classification for the purposes of IS1. IS1 says your classification is on the basis that you have a right of deferral beyond 12 months. And on that basis, that means it is a non-current liability by definition. On the basis that the intention is to pay within the next 6 months, that would be a disclosure point. So perhaps in the notes, or maybe even a footnote on the face of the statement of financial position, if you really want to emphasize it, but somewhere you need to make it very clear to the users, our intention is to settle this earlier, but our right is to settle it beyond, and on that basis, we've classified it as non-current. And then the last point, the last quiz before we take a short little break, Bamboos issued a convertible instrument to an investor. The instrument will be redeemed in 2025 in either shares or cash at the option of the investor. Bamboos accounts for the instrument as a compound financial instrument under IAS 32 and splits the instrument into debt and equity portions. How would we classify the instrument as at 31 December? While that quiz is coming through, or while the responses are coming through, I see another comment here. What about looking at the basis of substance over form? I'm not sure I follow the question in relation to what we're discussing here, because we are classifying according to the substance of the rights that we have. And the substance of the rights that we have is that this loan is non-current in nature. Our intentions to not exercise our rights by settling it earlier is just a different way in which we plan to realize it, but the substance of our rights is that we have a non-current liability. And on that basis, I would still say that nothing changes in respect to, I'm assuming that that's where the question is coming from, to say, is this, are we applying substance over form here in classifying the liability as non-current when our intention is to settle it on a current basis? Right, let us look at the results on the last case study. So in this instance, we have a vast, I think you can start to see that many of us have now realized all the points as we've been going along. So the vast majority seem to be in favor of non-current. And it goes back to the earlier point that I said, doesn't matter whether I'm issuing in shares or in cash. I look to when would settlement be due in either shares or cash. Settlement would only be due in 2025. And on the back of that, then we would say non-current. Whether or not we settle in shares or cash is irrelevant. We look to when is settlement due, what are our rights in respect of that date, and that is the basis by which we would classify. So there would be no basis to classify this as current under the guidance that I've explained. Just to this point, IAS 32 explains the distinction between debt and equity. In fact, that's actually one of the projects that the board is still working on, which financial instruments with the characteristics of equity. The distinction between debt and equity happens under IAS 32. We don't classify equity between a current and a non-current portion. We only classify liabilities and assets between current and non-current. But on the outcome of the IAS 32 assessment, we take the liability as being the result out of that. Even though it might be a liability, if it's settled in shares, we then determine what is the settlement date, and that would be the basis by which we would classify the distinction between current and non-current. Right, so based on those 5 case studies, that ends our discussion on the amendments to IAS 1 relating to the distinction between current and non-current. The effective date when the amendment was first issued last year was for the effective date to be 1st of January 2022. As a result of the COVID-19 pandemic, the ISB amended the effective date. So even before it came into effect, the amendment was amended to allow for a further year before it becomes mandatorily effective. So the amendment is effective for years beginning on or after 1st of January 2023. And when it is first adopted, the amendment must be applied retrospectively, which means any comparative liabilities need to be applied, classified according to the revised definition, according to whether they are current or non-current, which may result in restatements of comparatives. I'm going to pause for a moment there and see if anybody has any further questions, but then at the same time, I'm also going to introduce our break. So we're going to take a short little comfort break, a 10-minute break. If any of you do have any questions, please send those through in the Q&A box. And on the return from the break, we can then respond to any questions that come through. Thank you. Right, very welcome back, everybody. We're going to carry on with the program. During the break, there were a couple of questions that have come in. So before I go back to the agenda, I'm just going to respond to the questions in the order in which I see them coming up in my screen. I see a question here. According to ISB, IFRS 17 is effective for annual reporting periods beginning on or after 1st of January 2023. What do you think the big challenge for practitioners in Cambodia is, and should we get ready, and what should we get ready for the standard? So the question is referring to IFRS 17, which is the standard on insurance contracts. And I guess it is going beyond the scope of our discussion here today, given that that is, it's a very specific standard that's, and one of the major standards over the recent past. I'm going to respond very briefly by saying, well, the insurance industry is going to be significantly impacted by the standard, either from the perspective of the processes in terms of applying the standard, to the extent that IFRS 17 differs from the accounting policies that insurers have been applying in the past. There may be a change in the outcome of the timing of revenue recognition for insurance contracts, in terms of the measurement of some of the insurance liabilities that the company recognizes. And certainly there will be a difference in disclosure requirements relative to what the old standard IFRS 4 used to require prior well, that still requires, given that IFRS 17 is not yet effective. The ISB has already deferred or delayed the effective date of IFRS 17 a number of times. Initially, it was supposed to be effective this year, 2021. It's been pushed out to 2023 because of the fact that insurers need more time to get ready for this. So what I would suggest an insurer would need to do to get ready for the standard is to undertake a comprehensive gap analysis of what the old standard, what the new standard requires, and what the insurer is currently doing. And on the back of that, to understand where the differences are in terms of recognition and measurement of insurance revenue and insurance liabilities, and then the disclosure requirements that come from that. And I guess that's the extent of how detailed I can get on that in the time available before diverging into a completely different topic. So yeah, IFRS 17 is certainly a big deal for the insurance companies, but it's something to take note of and to prepare for. There is still some time available. A question came in, again, around sustainability reporting. Remember, I said that the sustainability discussion is outside of the scope of IFRS. It was merely mentioned for the purposes of explaining that the IFRS Foundation is proposing the development of sustainability standards. Sustainability is a broader topic than just environmental reporting, climate reporting, although that is probably going to be where the board focuses its attention on initially. But it goes to social issues, it goes to other areas around how the company contributes towards society as a whole, and things around employee well-being. Those are all aspects around sustainability, because if you don't have a reliable workforce, then how are you sustainable as a business going forward? So there's lots of linkages to other things beyond just the numbers. And so the linkage to financial statements is around areas around going concern. Is the company a going concern? What is the cost of sustainability issues in the sense of dealing with climate provisions and environmental provisions and things like that? So there are linkages between the areas. Users of financial statements are also interested in the sustainability of a company, and that's how it fits into the broader realm of financial reporting. Another question came in around IS1, I presume, revised comes into effect on the 1st of January 2023. Can you early adopt? Yes, it is available for early adoption. The question came in, we have an accrual over tax reassessment, but we are not sure when we are going to settle. Should that be non-current or current? Since you know the tax team works slow, some companies I have known has this accrual in their balance sheet for a few years as well. My question is, if the tax reassessment, or if the tax authority, if the process comes to conclusion, comes to fruition, would the company, would the taxpayer be in a position to have a legal right to defer settlement beyond 12 months? If the answer is no, then it's a current liability. If the answer is yes, then it's a non-current liability. So it's not about when you think the tax assessment will be, or process will be completed, but rather what rights do you have to defer settlement beyond 12 months? And if the right does not exist, so it may even be a contingent liability, in which case classification as current and non-current is irrelevant. But if it is a recognized liability or provision, and you do not have the right to defer settlement beyond 12 months, then it is a current liability based on the definitions that we've spoken about. And then a question which I don't know if I'm going to be able to answer. Well, okay, maybe I can. If we have the new law in IFRS, do we need to adapt immediately after the announcement, or wait 2 years after the same to IFRS for SMEs? Remember, the IFRS for SMEs is a package of amendments that come out in a lump sum, and based on that, the entire standard will typically have an effective date to allow companies to prepare for it. Individual IFRS standards will have their own effective dates. IS 1, for example, has a January 2023 date. The other topics we'll be discussing this afternoon will have their own effective dates. So it comes down to what each standard says around the effective date as to when the effective date would be. IFRS 17 on insurance contracts is 2023, whereas one of the amendments that we're going to be discussing today has already come into effect from the beginning of last year. So it really depends on what the topic is, how complex it is, and how different it is from the old requirements, and the standard setters will take all of that into consideration in determining the effective date. Right, I think they've answered all the questions that came into the Q&A. Let us now go back to the next topic, and this is the one that I was talking about in passing. COVID-19 related rent concessions and the amendments to IFRS 16. Now, this is very topical at the moment, given that we are still in the midst of a global pandemic. And while some parts of the world have been less affected than others, it is certainly something that has changed how companies do business, how travel works, how the world operates in many cases. The issue is specifically related to IFRS 16, the standard on leases. And without now diverging into a refresher on how lease accounting works, which we can certainly cover in another webinar, but for the purposes of our discussion today, I want to focus specifically on what this amendment relates to. So very briefly, just to explain or set the context of this, when you recognize a lease as a lessee under IFRS 16, the lessee recognizes both a liability to the lessor for the rentals that have to be paid, and an asset representing the right of use that the lessee has received from that arrangement. The liability is measured at the present value of the future lease rentals that have to be paid to the lessor over the remainder of the lease term. So this all happens at the commencement date of the lease. The lessee determines the present value of the future rental. So by working out all of the rental payments over the lease term, however long that might be, you then discount that back to present value using either the rate implicit in the lease or the lessee's incremental borrowing rate if the implicit rate cannot be reliably determined. And you then end up with the present value of the future rental payments, which are then subsequently paid over the lease term. I'm not going to talk about the asset for the moment, but basically the asset comprises the cost of the liability and any upfront payments that have already been paid, plus any directly attributable costs to the lease. But as I say, the idea here isn't to refresh everything about lease accounting, but rather to talk about a particular area of lease accounting that has been affected by COVID-19. After initial recognition of the liability at present value, the liability is subsequently remeasured by amortizing it to zero. And how we amortize it is by increasing the carrying amount of the liability to reflect interest, the unwinding of that present value, of that discount that you used to get to the initial present value. So that liability there will be an effective interest charge recognized in the income statement for the interest cost of the lease. We will reduce the liability to reflect the lease payments, and over time, you'll find that slowly but surely you will eventually have repaid the liability, as with any loan that is effectively amortized to zero. However, the liability is also amended or adjusted by adjusting the carrying amount to reflect any reassessments of the liability for example, if the lessee has the right to renew the lease and didn't think that it was going to renew the lease, but then it chooses to renew the lease, the lessee might need to adjust the lease liability to reflect the renewal of the lease that it had already from the original terms of the lease. Likewise, if the lessee had a bargain purchase option, but said maybe thought it was going to exercise the bargain purchase option, and then subsequently decides not to, that's going to affect the amount of the liability, because the liability would have included the bargain purchase price if it was assumed that the bargain purchase would have been exercised. So these types of reassessments are based on adjusting the liability for rights that already existed in the lease contract. But at the same time, the lease contract itself may be modified, giving rise to adjustments to the lease liability. So what happens then is, to the extent that there's a reassessment or a modification of the lease payments, or a modification of the lease payments needs to be updated, with the result that the liability is remeasured. And to the extent that there is a modification that increases the lease liability or reduces the lease liability, that adjustment is pushed back against the right of use asset, just to link it back to that. So the only linkage between the right of use asset and the liability after initial recognition is to the extent that there's an adjustment to the lease liability for a reassessment or a modification. Otherwise, the asset is depreciated over the lease term and the liability is amortized using the principles that I mentioned on this particular slide. The focus here is on a lease modification. Lease modification is a change in the lease scope or the consideration in the lease that was not part of the original lease. In other words, it's a change to the lease contract itself. A change in the scope means there's a change in the right of use conveyed to the lessee, and a change in consideration refers to a change in the lease payments, either increasing or decreasing the lease payments. Remember that a change in the pattern of the lease payments could also change the consideration, because of the effective time value of money, if payments are going to be made later or earlier than previously required in terms of the lease, that has the effect of changing the consideration payable. Even though it might still be the same overall absolute number, the value of that lease payment changes as a result of a change in the terms of the lease. So if the lease is modified, what happens then is that the lessee has to, for all intents and purposes, calculate a brand new lease liability. You need to calculate the revised lease term. You need to calculate the revised lease payments. You need to calculate a new discount rate as at the date of the modification. So you are basically recalculating your lease from scratch. And then to the extent that the carrying amount of your liability is now different to what it was before the modification, any adjustment to the lease liability that reduces the scope goes against the right of use asset. And there's also a partial gain or loss recognized on termination in profit or loss. And to the extent that the modification increases the scope of the lease, well, then the increase is pushed onto the right of use asset as well. So to summarize, a lease modification, in effect, results in a recalculation of everything to do with the lease. It affects the calculation of the lease liability. It affects the calculation of the right of use asset. It involves a new discount rate. It's basically starting from scratch and taking the adjustments as I've explained them. Enter the COVID-19 pandemic. And during the COVID-19 pandemic, many countries have gone through various degrees or levels of lockdowns. We've seen some countries implementing hard lockdowns where companies when full economic activity came to a grinding halt. In other cases, you've seen restrictions around travel. You've seen restrictions around just simply declines in certain demand for goods or services. And the result is that many lessees have been approaching their landlords, particularly in the rentals premises space, to say, I can't access my premises, or I can access my premises, but my customers can't come to me, so I may as well have closed down. And during these various lockdowns and the consequences of COVID-19, lessors have provided some form of relief in the form of rent concessions to lessees. This means that any concession in the form of a reduction in rental payments on an existing lease, or a delay in lease payments, or perhaps a rental holiday, they can take various forms. But every one of these concessions would have been or should be considered a lease modification according to the principle that I've just explained. Because if you, I mean, you may not be extending or affecting the scope of the lease, but if you are adjusting the lease modification, if you are adjusting the lease as a result of a change to the consideration that was payable, you are changing the terms of the lease, and that gives rise to a lease modification. And the implications of a lease modification are that at the date of the modification, you will need to account for the change at that point in time by recalculating the new lease and comparing that to the previous lease, and any difference push back against the right of use asset at the date of the modification. I see a question's just come in over there. Do you adjust the lease modification retrospectively? No, you adjust at the point of the modification, but the impact affects both the right of use asset and the lease liability. You don't go back and change comparatives if the lease modification happened in the current year. You adjust the lease at the point of the modification. So then the question is, well, so we've got guidance around how to account for a modification. So in and of itself, there's not a problem with that. But now let's understand where we are at this particular point in time. IFRS 16 came into effect for years beginning on or after 1st of January 2019. So that was the effective date of IFRS 16. And that means that for any company that had a December year end, it means that it was already effective in December 2019. For companies that have year ends after this or outside of December, in other words, any other calendar month, it meant that it was mandatorily effective in the 2020 financial year, the year ending 2020. When did COVID-19 break out? In the early part of 2020. So you have a situation where if you're a company that has lots of leases, for example, in the retail space, in the retail environment, retailers typically have lots of leases in shopping malls, in commercial districts, and all of that, all over the place. So if you are a retailer that has lots and lots of leases, you have now just come through an exhaustive exercise to transition to IFRS 16 in your 2020 financial statements, mostly, unless you had a December year end, you would have just done it at the end of December 2019. And then at the start of 2020, suddenly COVID comes along, and around the world, lessees are now receiving these concessions from lessors. That requires you to go and start the whole process again and recalculate all of the leases where you've just received a rent concession. And this is the particular conjunction of two events happening. You've got the initial adoption of IFRS 16 for lessees, and you've got the outbreak of COVID-19 with all of these concessions, and the ISB was convinced under the circumstances to make an amendment to IFRS 16. It's a once-off. I can't imagine that the board will ever do this again in other instances unless there's a compelling reason to do so. But the board felt that it would be unkind to expect companies to now have, they've just brought all these leases on board, to go and recalculate them, to now have to go through that exercise under the circumstances. So the board made a limited practical, introduced a limited practical expedient into IFRS 16 for COVID-19 related concessions. And what I mean by that is, this is limited only to the extent that you have a rent concession that has the following three conditions, where the following three conditions apply. Firstly, it applies only to rent concessions that affect lease payments that result in revised consideration for the lease that is substantially the same as or less than the consideration for the lease immediately preceding the change. In other words, if the parties are coming to the table now, coincidentally, when all of this is happening, and increasing the payments or modifying the lease in a way that increases the payments, then that does not qualify for this relief. This is only for relief that either keeps the consideration the same, but maybe changes the pattern of the payments, or has less consideration but not in the event that the consideration increases. Secondly, it only is valid for lease payment to the extent that the modification reduces lease payments that were originally due on or before the 30th of June. Initially, when this came out last year, it said 30th of June 2021. When this relief was first introduced last year, it said 2021. But given that we're in 2021, we're almost through 2021, and COVID-19 is still around us, the ISB amended this further earlier this year to extend the relief to 2022. We don't know if they'll extend it again, but as things currently stand, it applies to payments due on or before 30th of June 2022. And thirdly, the effect of the modification must be that there's no other substantive change to the other terms and conditions of the lease. In other words, it must only relate to reduction in rental payments, reflecting payments within that period of time that I've indicated, with no other substantive changes to the terms and conditions. So if the modification does not meet all of these criteria, it is not considered a COVID-19 modification. And on that basis, the normal modification guidance will apply, which is what I've explained previously. But to the extent that it's a COVID-19 rental concession that meets all of these criteria, the effect of the practical expedient is that the lessee can account for the qualifying rent concessions as if they are not lease modifications. In other words, you could treat it as an extinguishment of debt, or a change in a pattern of amortization, or a variable rental payment. In other words, just take the effect of the adjustment directly to profit or loss without amending your lease liability value or your right of use value. Depending on the circumstances, you would need to assess what the nature of the amendment is and what the appropriate accounting treatment would be. But you would not be required to calculate a new pattern of lease payments, a new discount rate, and adjust the right of use asset, because that's what would be required for a lease modification that is not a COVID-19 rental concession. There is no change for lessors. So lessors that are granting the concessions do not have any amendment. They need to apply the existing modification guidance within IFRS 16, which requires them to adjust appropriately, adjust the straight lining if it's an operating lease, or adjust their in net investment in the lease if it's a finance lease. But the reason for that is because while lessors are also affected by COVID-19, they have not just come through a process of adopting a new standard, because IFRS 16 carried forward the lessor accounting principles largely unchanged. So it reminds us again that the relief was specifically because of the timing of the adoption of IFRS 16 for lessees and the timing of COVID-19 concessions that justified this exception. There's no exception available for lessors. The expedient was an emergency amendment that was introduced. I think they started discussing it sometime in April. It was issued by the end of May and became effective immediately for companies that needed to adopt it. And it continues until just up to 30th of June 2022, and thereafter it shall have no further effect. Any subsequent concessions thereafter, unless the concession period is extended, will not qualify for this relief. I see a couple of questions have come through, so let's just go through them. Firstly, if it is a leased land, does the entity still have to recognize the right of use of the land and depreciate it over the lease term? Oh yeah, so this has nothing to do with the COVID-19 concessions. It seems to be a question in respect of the application of IFRS 16, but let me just answer it very briefly. The reason why land is not depreciated is because land has an unlimited economic life if you own it. If you don't own it, your rights to the land are limited to the period of time for which you have the right to use the land. And therefore, you would still need to depreciate the right of use that has been granted. We're depreciating the right of use of the land, not the land itself. So to the extent that you are leasing land, your lease term defines the upper limit of your useful life, and you will have to depreciate it over the lease term or a shorter period of time if you are not expecting to utilize that land for the entire duration of the lease term. And then a question came in, what if instead of the consideration is less, but the lease term is modified to be shorter? Is it considered to be amendment? No, then I think we're talking about something different, because then you are changing the scope of the right of use. And I don't believe that that would qualify for the relief that the amendment was trying to provide for. Remember that the relief is limited to relief around the consideration paid. Any other change to the lease term, such as shortening the life of the lease, in my mind, would not qualify for the relief that is envisaged here. I see another question came in through the Q&A, sorry, through the chat. Okay, let's just have a look here. During COVID-19, a shop was closed for half of the month, only 1 month, and the lessor agreed to reduce the consideration. Should I do a reassessment or remeasurement? Well, assuming that we are within the scope of IFRS 16 and we are in the scope of the period covered by the relief, if the lessor agreed to reduce consideration, but there was no change to the scope of the right of use, then you potentially qualify for the relief in terms of the what we've just discussed, the relief introduced by IFRS 16. That means that you can now choose. You can choose to account for it as a modification. And if you choose to account for it as a modification, then that means calculating a new lease at the date of modification and pushing the adjustment against the right of use asset. If you choose to apply the relief, which is optional, it's not mandatory, then you don't have to do a reassessment or a modification. You can then elect to account for the relief as debt extinguishment and take the difference straight into P&L. You were supposed to pay this amount of rental this month. You ended up paying less, and therefore the difference that you've been relieved of is a gain that you recognize in profit or loss, or a variable lease payment, as the case might be. In some cases, the relief may have been in such a way that for the months in which you were locked out of your premises, you have been given a rental holiday, but then the subsequent rental payments for the remainder of the year have been increased to adjust for that. As long as cumulatively the overall rental payments do not increase the consideration payable, then you still qualify for the relief. And then all you're doing is you're just amending your amortization, but you don't need to account for a new lease. In other words, calculate a new discount rate and so on and so forth. I see another question here. The lease term is for 15 years. Okay, I'm not going to calculate these amounts now, I'm afraid. Okay, I can't give you the lease expense in the moment. I'm not going to calculate what the lease expense should be in the example that's been pasted over here. I guess in principle, what we're saying here is that to the extent that you have COVID relief that qualifies under IFRS 16, you can whatever the relief is, you can elect to either recalculate your lease liability, or you can recognize the difference immediately in profit or loss. With a modification, there is no restatement of previous years. Whether it's COVID relief or not, there's no restatement when it comes to a modification, because a modification says from the date of the modification, you calculate the new liability going forward and adjust against the right of use asset. So whether it's the COVID modification or another modification, there's never a restatement of previous years, unless of course you've made an error in previous years, but that's separate. And then to the extent that you decide to apply this relief, all it means is that you don't need to recalculate a new liability using a new discount rate, which would otherwise be required if you account for it as a modification. I see a question here. Any side effects from the modifications to adopt with the COVID-19 situation to financial standards? I'm not sure and then a follow-up question, anyhow, could we control those side effects? I'm not sure I follow what you mean by side effects. I mean, the relief is that you don't now need to go and calculate new leases for a leasing schedule. I can't imagine that there would be any downside to adopting or to applying the relief where you can. But some companies might use it as an opportunity to, remember, if you were to apply a modification, you would calculate a new discount rate. you may find that based on where discount rates are now relative to where discount rates would have been at the point when you first entered into the lease, that the discount rates you would use now would be more favorable to you. And therefore, you're calculating a new lease using the current discount rates might actually be better for you. So even though it involves more work, you might choose to apply the modification guidance, even though you could qualify to not have to do so. So I think that's the decision that needs to be applied by way of accounting policy choice, whether or not you decide to or elect to apply the relief that's been granted in terms of these expedients. A question's come in, what if the criteria has been met after June 2022? Well, at this point, they don't qualify for the relief, which means you apply for it using full modification guidance, which is what we've been talking about up to this particular point. If the board feels that there's justification to extend again, that may extend beyond 2022, but we can't predict that or anticipate that. We will need to go with the principle that says if the payments are beyond 2022, or rather the impact on the payments is beyond 2022, then there's no, it doesn't qualify for the relief. I'm going to take one more question that's come in. No, okay, no, that was just thanking me. Okay. Folks, that is the COVID-19 amendments. I'm going to move on then to our next topic, which is the annual improvements to IFRSs. Oh, my apologies. It seems like I have skipped one of the topics. Sorry, before I move on to the amendments, those of you that have been following in the material were probably wondering why I skipped over the provisions guidance. Apologies for that. I guess when I came back from the break, I clicked on the wrong point, but let's talk about that now. So IAS 37, the standard on provisions, contingent liabilities, and contingent assets, deals with three distinct things, as you can see over there. It deals with liability accounting, essentially. Even though it touches on contingent assets, it doesn't talk about accounting for such things other than to remind us that a contingent asset is only recognized when it is virtually certain that the future economic benefits will flow back to the entity. But by and large, IAS 37 is a liability standard. And in terms of IAS 37, a provision is a liability of uncertain timing or amount. In other words, it applies to a present obligation arising from past events that requires an outflow of economic benefits in future, but there's an uncertainty either with respect to when payment is due, when settlement is due, or there's uncertainty as to how much is due for settlement because there's no contract that defines the amount that's due for settlement. So as a result of that uncertainty, we have a provision by definition. If we've got a contractual obligation to pay an amount in future, then that's not a provision, that's a financial liability, and we have IFRS 9 that governs the accounting for that. IFRS 9 would then typically say, well, you've got a due date, or a due date can be determined, you've got an amount that can be determined, and therefore the guidance under IFRS 9 is very clear around how to measure such a financial liability. But with a provision, because there's typically a non-contractual obligation, which may arise from legislation, it may arise from claims by other parties where there's no contractual obligation and may be subject to dispute. There may be a number of reasons why we end up with a provision. So IAS 37 explains that a provision is measured at the best estimate of the most likely outcome. That also takes into account your best estimate of when payment is due and how much payment is due at a particular point in time. IAS 37 has a scoping exception which says, to the extent that you are party to an executory contract, an executory contract is not recognized as a liability unless it is onerous. So what is an executory contract? An executory contract is a contract that has either not been executed, in other words, neither party to the arrangement has acted in respect of their respective rights and obligations, or both parties have acted to the same extent. So let's go with an example for a moment. Let's assume that today on the 19th of September, we enter into an agreement whereby I will manufacture and supply widgets which I will then deliver to you in batches over the next several months. Let's say over the next 6 months, I'm going to deliver batches of widgets, 100,000 widgets each batch. So I'm going to deliver 600,000 widgets to you over the next 6 months at an agreed price of $5 per widget. All right. As of today, do you have to recognize do any of us have to recognize a liability? Either myself or yourself as my customer, does either party have to recognize a liability? Now, I don't have a poll for this question, but you may be nodding your head, or you may be shaking your head, or you may be speaking back to me, in which case I can't hear you, but nevertheless, the answer is this contract is an executory contract, because as much as we have a contractual obligation, well, both have contractual rights and obligations. I have a contractual obligation to deliver 600,000 widgets to you. You have a contractual right to receive payment for those, and you have a contractual obligation to pay me for 600,000 widgets at the agreed price per widget. And sorry, Casey, did you have something to add there?
No, my apologies.
Okay, sorry, I just heard you coming through. Okay, so in that contractual arrangement, I have a contractual right to receive payment for my 600,000 widgets, but a contractual obligation to deliver 600,000 widgets. You have a contractual obligation to pay me for 600,000 widgets and a contractual right to receive the 600,000 widgets. So we each have contractual rights and obligations, but on the date of signing, neither of us have acted in respect of our respective rights and obligations. I do not have to recognize any liability for the widgets I have to manufacture. You don't have to recognize any liability for the payment that you have to make, even though you, by definition, do have a liability to me. As a result of that executory contract, you have a liability to pay out cash for the 600,000 widgets at the price that we've agreed to of $5 per widget. However, you do not recognize that liability because of IS 37 scope that says in an executory contract, that contract has yet to be executed, and therefore do not recognize a liability for that contract, except if that contract becomes onerous. So if that contract was to become onerous, at that point in time, that shield, that exception from recognizing a liability falls away. It doesn't mean now that suddenly a present obligation has arrived. That obligation was there all along. It's just that the obligation was subject to execution of the contract, and therefore the shield from recognizing the liability disappears the moment it is determined that that contract is an onerous contract. So what is an onerous contract? Well, an onerous contract is a contract in which the unavoidable costs of meeting the obligation exceed the economic benefits expected to be received. And to the extent that that contract becomes onerous, the onerous contract is then measured at the lower of the fulfillment cost or any compensation or penalties arising from failure to fulfill it. So let's just extend my example slightly. So we said 600,000 widgets at $5 a widget. As it turns out, it's going to cost me $6 per widget to make the widgets. I was using last year's price list. Unfortunately, I didn't realize that. I gave you price in the $5 a widget, but it's going to cost me $6 a widget to produce and sell those widgets to you. The unavoidable cost of meeting my obligation is going to exceed the economic benefits expected to be received from that obligation. And on that basis, I am now in an onerous position. I'm basically contracted to make a loss, and therefore I need to measure my obligation at the lower of the fulfillment cost or any compensation or penalties arising from failure to fulfill it. In other words, if there was a penalty payment that I could make to extricate myself from this obligation, then I would measure it at that lower value. The standard reminds us that the presence of an onerous contract indicates that there could be an asset impairment that we need to consider to the extent that there's an asset dedicated to that onerous contract. So, for example, the fact that now the contract is onerous, I might now need to go and look at my production costs and the assets involved to see whether my manufacturing plant is potentially impaired. But that's, by the way, that's just a consequence of identifying an onerous contract. Now, folks, the guidance that you see on the slide in front of you has been in IAS 37 for many, many years, for decades. That hasn't changed. But the question that has led to the amendment that we're discussing here was, which costs do we need to consider when assessing if a contract is onerous? And this came about as a result of an implementation question that was submitted to the Interpretations Committee. Some companies were looking to the incremental costs of fulfilling the contract. In other words, only looking to the additional costs that would be incurred if the contract was executed. And others were looking at allocating all costs necessary to fulfill the contract. In other words, both the incremental costs as well as the non-incremental, the sunk costs that are going to be incurred no matter what. But to the extent that they are directly related to fulfilling the contract, they would look to those costs in determining which costs are necessary, are linked to that contract for the purposes of identifying whether the contract is onerous. In other words, for calculating the unavoidable costs of meeting the obligation. And this is essentially what the guidance now says. So as a result of the amendment now confirms that you look to all costs that are directly attributable to fulfilling the contract, not just the incremental costs of fulfilling the contract. So, for example, incremental costs in my example would be the direct labor of manufacturing the widgets. If I don't manufacture the widgets, I'm not going to incur that cost. But to the extent that I've got manufacturing overheads in my factory that I'm going to incur whether I make the widgets or not, but which I directly attribute in my production cost to the cost of each widget, I will look to the total manufacturing cost of manufacturing the widgets, both the incremental costs and the other manufacturing costs, and use that as the basis for assessing whether my contract is onerous or not. And then once I've determined that a contract is onerous, I then measure my provision for the onerous contract according to the guidance that I mentioned previously, which has always been there in IAS 37. The amendments to IAS 37 are effective for years beginning on or after the 1st of January 2022. Early application is permitted. It applies to all contracts for which the entity has not yet fulfilled its obligations. In other words, to all executory contracts that exist at the beginning of the annual period in which you first apply the amendments. In other words, you don't go back and restate the past. This particular amendment is done on a prospective basis in the year in which you first apply the standard. So if your year end is December, on the 1st of January 2022, you will assess all of your executory contracts in progress at that point, and you will assess them as to whether or not they are onerous based on this revised definition that I've just mentioned. And on the back of that, if the contract is now onerous, you will recognize your provision for an onerous contract at the beginning of 2022 and push the adjustment into equity rather than affecting your current year profit or loss. And then going forward, any contracts that become onerous contracts thereafter will be measured and recognized at the point at which they become onerous. Are there any questions in respect of the amendments to IAS 37? I'm not seeing any typing. I'm not seeing any Q&As coming through. To the extent that any of you do have any questions, please send them through and I'll get back to them then at the end of the session. Our next amendment that we're going to discuss is IAS 16, amendments to property, plant and equipment. Again, this is a long-standing standard. It's been around for many, many years. My aim here isn't to go into all of the issues around things like depreciation and revaluations and all the rest. I'm going to focus my discussion on the specific areas affected by the amendments. Property, plants and equipment is measured initially at cost under IAS 16, and cost includes the purchase price, Any import duties and non-refundable purchase taxes. We deduct any trade discounts and rebates. And we include any cost directly attributable to bringing the asset to its location and condition necessary for it to be capable of operating as intended by management, as well as the initial estimate of the costs of dismantling and removing the item and restoring the site on which it is located. So I'm going to open up a case study to ask you which of the following costs should be capitalized to an item of property, plant, and equipment in terms of IAS 16. It's the same link that we used before the break. So those of you that did participate, if you've still got that link open, it should switch over to allow you to respond. Please tick all that apply, all that you believe apply, or just tick none of the above if you think none of the above should apply. But let's wait and see what the responses are. And then we can talk about what the impact of the amendment in question is all about. I see a question has come in, which is not related to IAS 16, but I will answer it just while I'm waiting for the responses on the case study in question. The question is a loan guarantee considered a contingent liability? Please elaborate more on what to disclose in the financial statements for this. If you have guaranteed a liability of another party, if you've contractually agreed to stand as surety or guarantor for somebody else's liability, that is a financial instrument. And in terms of that, you would need to account for it under IFRS 9 as a financial liability. There is specific guidance within IFRS 9 to measure the liability using a methodology that is similar to measuring expected credit losses on financial asset receivables. Because the idea is that you are exposing yourself to the credit risk of the company whom you are guaranteeing, or the entity that you are guaranteeing. And on that basis, then you would measure your liability, taking into consideration the probability of default, taking into account the loss in the event of default, and so on and so forth. So it's very similar in many respects to measuring credit losses for financial asset receivables. And there's additional disclosure in IFRS 7 in relation to that. Right, I'm seeing the responses ticking in. I'm going to give it another few seconds, and then we will look at the results. Okay, let us look at the responses. So the clear support for initial delivery and handling costs, yes. Installation and assembly costs, yes, to the extent that it's directly related to getting the asset in its location and condition to operate as intended by management. Costs of testing whether the asset is functioning correctly, yes, that seems to be have a lot of support. Training costs had some support, but limited support. I guess for those who selected that option, let me explain that costs of training your staff to use an asset is not a cost of getting the asset in the location and condition so that it can be used as intended by management. It's a cost of operating the asset rather than a cost of acquiring the asset. And by the same reason that if you need electricity in order to be able to use the asset, you can't capitalize the cost of electricity. Likewise, if you need to train your staff so they can use the asset, you can't capitalize the cost of training. So only costs that change the condition or location of the asset are costs that qualify for capitalization. The net proceeds from selling an item produced while bringing the asset to the location and condition, so it can operate as intended by management. Limited support, we'll come back to that one. The fair value of derivatives to purchase property, plants, and equipment in a foreign currency where hedging is not applied. Well, there was your clue. If you're not applying hedge accounting, then you need to deal with the gains and losses on the hedging instrument separately in profit or loss. If it's a qualifying hedging relationship, then you would be able to effectively bring in the gain or loss on the fair value of the derivatives used to hedge the purchase price of the asset in the measurement of your property, plants, and equipment. Limited support for employee benefits of admin staff, and limited support for none of the above. I think that was the shortcut that some of you took, but definitely some of these costs would be capitalized. But certainly I would agree on the employee benefits of admin staff. If that's not directly related to the acquisition of the asset, it doesn't qualify for inclusion in the cost of the asset. So folks, let's talk about this part over here, the net proceeds from selling any items produced. Many of you said you would capitalize the cost of testing whether the asset is functioning correctly, but few of you said that you would capitalize or adjust the cost of the asset by looking at the proceeds from selling any test or prototype units produced while bringing the asset to its location and condition. And that is exactly where the problem that the amendment addresses comes from. The amendment came about because there was inconsistent application around a very old and very long-standing principle within IAS 16 that said that when you are capitalizing costs of an item of property, plants, and equipment, if you are incurring costs to manufacture or produce test or prototype units, you're busy using equipment, machinery to manufacture widgets. So you've just acquired this equipment. You now need to test it to see whether the calibration of the widgets is correct. So you run a couple of test runs of production runs, and based on the output of those test runs, you will take those test prototype units and sell them. And you will then receive sales proceeds from those test items that have been sold. IAS 16 says you deduct the net proceeds from selling any items produced while bringing the asset to that location and condition, and you also capitalize the costs of testing whether the asset is functioning correctly. So this has always been a requirement of IAS 16. I guess some of us may have found it odd because we're not in that space, but if you're in the manufacturing space and you've been buying plants and machinery, I'm pretty sure you were aware of this requirement that has always been there. The problem is that some companies were applying this requirement differently in practice. Some were deducting the proceeds from testing, and others were deducting the proceeds while bringing the asset to its location and condition. And based on that distinction, it could be quite significant. And so this question, once again, was a referral from the Interpretations Committee. Somebody wrote to the Interpretations Committee and said, what is the correct treatment? And the Interpretations Committee acknowledged that there's a problem with this principle in IAS 16, and therefore an amendment is required. And the result of the amendment is that going forward, we will no longer be deducting the sales proceeds from the cost of the asset. Going forward, any sales proceeds from selling such items of property, plants, such prototype items will be recognized as income in the period in which those goods are sold. You will capitalize the costs of testing the asset and capitalize the costs of calibration and all of that, as has always been the case for directly attributable costs. And any items produced during these test runs, these test cycles or prototype units, the cost of manufacturing those items will be measured using the principles of IAS 2. So now, if you were a company that was deducting these costs from the cost of property, plants, and equipment, going forward, this is going to be quite a significant change once this comes into effect. In addition, there's now been a further clarification explaining that the directly attributable costs include the costs of testing whether the asset is functioning correctly. And an asset is functioning properly when the technical and physical performance of the asset is such that it's capable of being used in the production or supply of goods or services for rental to others or for administrative purposes, kind of clarifying the end point at which you would stop capitalizing these so-called testing costs going forward. The amendment introduces some additional disclosure requirements. You would now need to disclose separately the amounts of proceeds and costs included in profit or loss that relate to items produced that are not an output of the ordinary activities. In other words, these sales of prototype items that might not necessarily be included in the revenue line, but which would be presented in the other income line to the extent that it affects the company. The amendments are effective for years beginning on or after the 1st of January 2022. Early adoption is permitted, and the application of these amendments is retrospective, but limited to the beginning of the year of the comparative year relative to when you first apply the amendments. So what I mean by that is, let's just go back to a December year end. If you've got a December year end, in your December 22 financial statements, you will go back to plant and machinery that was brought into use from the beginning of January 2021 and adjust your cost of those items to exclude the cost, or to exclude sales proceeds to the extent that the cost of those items included the sales proceeds, as we've been explaining in the section. But any items of property, plant, and equipment that were brought into use before the beginning of the comparative period are left as is. So it's limited retrospective. We restate our comparatives for 2021 for items of plant and machinery that were affected in the comparative period, but not for years before the comparative period. And those are the amendments to IAS 16. Once again, I'm just going to pause to see if anybody's got any questions. If you've got a question, please type your question in the Q&A box, and I will respond to any questions that come through the Q&A box. We now turn our attention to the last section. The last section deals with the annual improvements to IFRSs. I'm going to go through these at a relatively high level because they are at a very, very narrow scope level, and they, in many cases, deal with very specific, very obscure issues, but nevertheless, they are necessary amendments that the IASB had to make, but they weren't urgent amendments, and the board's feeling was that they were not going to be a massive issue for many companies that apply IFRS standards. Just a reminder in terms of how the annual improvements project works. It's basically a mechanism for the IASB to deal with a number of necessary but non-urgent amendments, exactly why these things are not dealt with on a standalone basis. But as the board becomes aware of necessary amendments to standards, they will collate almost like a to-do list, almost like a shopping list in each year to say, right, these are the things we're going to deal with in our next annual improvements project. And they are often unrelated issues, but they come about, the common feature, the reason why they are dealt with together is because they came up in a particular cycle. So in this instance, we're talking about issues that arose in 2018. They were discussed and debated in 2019, and they were issued for amendment in 2020. All of these amendments are issued simultaneously, but they may have different effective dates. They deal with different issues altogether. And some might apply to some companies and not to others. So with respect to the annual improvements project for the 2018 to 2020 cycle, there were 4 batches of amendments. The first relates to IFRS 1 on first-time adoption of IFRS standards. In terms of IFRS 1, you are required to apply IFRS 1 if you are a first-time adopter, and you are a first-time adopter if your previous financial statements that you've published did not have an explicit and unreserved statement of compliance with IFRS standards. That basically means that if you are applying IFRS standards for the very first time in the current year, you are a first-time adopter applying IFRS 1, and the principles of IFRS 1 are such that you would typically apply you'll apply IFRS 1 on a retrospective basis. In other words, you would go to your transition date. Your date of transition is the beginning of the preceding year. And on the date of the transition, you would then recognize and measure your assets and liabilities according to IFRS rules. If you've recognized and measured those assets or liabilities at different values under your previous GAAP, then you would recognize the effects of that transition in opening equity as at that date of transition. But there are some exceptions to that retrospective approach to recognizing, to adopting IFRS for the first time. And IFRS 1 contains a whole host of optional exceptions or exemptions that are available in many cases on a case-by-case basis, independently of one another, that make the adoption a little bit easier depending on the circumstances in which the company is adopting IFRS standards for the first time. So for example, there are exceptions around using deemed cost instead of the actual cost that an item cost you at a particular date. You can use the fair value on the date of transition for certain assets. There are exemptions from applying things like business combinations and so on. I'm not going to go through the whole list because this isn't a discussion on IFRS 1, but rather to highlight the specific amendment that has been made to IFRS 1 as part of the improvements project. So one of the optional exemptions is to allow a first-time adopter an exemption from having to recognize a foreign currency translation reserve for certain of its, well, to the extent that it has foreign subsidiaries, there's an exemption to recognizing a foreign currency translation reserve as if you've always been on IFRS standards. You can basically reset your FCTR for assets and liabilities measured, assets and liabilities of a subsidiary that has a different functional currency to your own. If a subsidiary adopts IFRS later than its parent, that exemption from recognizing the FCTR typically can also be applied by the subsidiary in relation to assets and liabilities of that subsidiary. So if a subsidiary becomes a first-time adopter later than its parent, the subsidiary can either measure its assets and liabilities using full IFRS, retrospective IFRS application, or it can carry forward the assets and liabilities values that its parent used when it first applied IFRS for the first time. Now, the problem with that exception that has always been available to a subsidiary that adopts IFRS earlier than its parent is that it was available for assets and liabilities, but it didn't extend to equity balances of a subsidiary, which meant that the subsidiary could bring on the assets and liabilities using the values that its parent used for that subsidiary on first-time adoption of IFRS standards, but it could not carry forward the value ascribed to the equity balances, such as the FCTR balance, which I've just mentioned previously. And so all that the amendment has done is it allows a subsidiary to apply the same principle that I've just mentioned around carrying forward or pushing down the values of the assets and liabilities to equity balances such as the FCTR as well. Instead of resetting the FCTR to 0, the subsidiary can carry forward any FCTR balance that it had ascribed to that subsidiary in relation to the first-time adoption of IFRS standards. So as you can see, it's a very, very specific set of circumstances where this amendment would have any relevance. Firstly, it would apply to a first-time adopter, a group that's a first-time adopter of IFRS standards. It would then also have to apply to a subsidiary that adopts IFRS after its parent adopted IFRS. It would also apply to, have to apply to a subsidiary that has an FCTR balance. And under those circumstances, the amendment now allows for the exception to be extended to that very specific set of circumstances. But unless all of those scenarios apply, the amendment has no other consequence, no other practical application. If you are already on IFRS, this amendment has absolutely no bearing or impact on anything that you are doing. Even if you are already on IFRS and you would have qualified had this exception been available at the time when you transitioned to IFRS, your first-time adoption process closed the moment you were no longer a first-time adopter. So once you have moved past that first year of adoption, everything in IFRS 1 is of no relevance to you going forward. The next amendment is something that may have a bit more impact on a more pervasive basis. Under IFRS 9 financial instruments, a financial liability is de-recognized when the liability is extinguished, either because the obligation has been discharged, has been cancelled, or has expired. So we recognize the liability when we become a party to the contractual provisions of the contract. And we derecognize the liability when the liability is extinguished. However, IFRS 9 carries forward the derecognition guidance of its predecessor standard IAS 39, which says that if a borrower and lender exchange debt instruments with substantially different terms, then that must be accounted for as an extinguishment of the original financial liability and the recognition of a new financial liability. Now, what that basically means, it's very similar to that modification principle that we spoke about earlier for leases. The language used is different, but it has the same effect. It basically says, if you are modifying the terms of a contractual liability with the counterparty, so you're the borrower and you've negotiated new terms with the lender, you are exchanging different debt instruments. And if they have substantially different terms, then that is considered to be a substantial modification and must be accounted for as an extinguishment of the old and the recognition of a new. The way in which the standard defines a substantial modification is on the basis by which the discounted present value of the cash flows of the new terms, including any fees paid, net of any fees received, and discounted using the original effective interest rate, is at least 10% different from the discounted present value of the remaining cash flows of the original financial liability. So just to reword that again in perhaps a bit more of an understandable manner, the idea here is that if you do two present value calculations, the present value of the original liability using the original discount rate and the modified payments under the revised liability using the original discount rate that you used for the original liability, if you compare the present value result of both of those calculations and the difference is more than 10%, falls outside of that 10% corridor, then it's a substantial modification. If the difference falls within 10%, then it's not a substantial modification and you just adjust the liability, the existing liability, without accounting for an extinguishment of the old and the recognition of a new. So really the question here is around which fees, when one looks at the fees paid, net of fees received, which fees should be included in the 10% test. They are not changing the 10% rule. They're not changing the 10% requirement. They're not changing the effects of the 10% test. They are just expanding the clarification to explain which fees we look at when we consider the 10% test. And the reason for this is because when a liability is modified, it often happens that the parties have to pay all sorts of fees. There will be legal fees. There may even be tax consequences from the transaction. There may be stamp duties. There may be commissions and things like that, which are payable. And the question is, out of all of those costs that might be incurred, are those factored into the assessment of the 10% rule? And the amendment clarifies that the only fees to include in your 10% test are fees paid or received between the borrower and the lender, and between the parties received or paid on each other's behalf to the extent that they relate to amounts whereby one has simply paid on behalf of the other. But that means that any legal fees or other costs incurred at the same time or as a consequence of the modification are not considered for the purposes of the 10% test. So if there is a commission or fee payable to the borrower, to the lender, as a consequence of the renegotiation or as a consequence of the modification, that will factor into the determination of the 10% test. But the fees paid to the lawyers or the tax authorities are excluded, unless, of course, you're paying fees on behalf of the other party, in which case then you include those in the assessment of the 10% test. The third amendment deals with an amendment to not the standard, not IFRS 16. We've already spoken about an amendment to IFRS 16 around COVID-19. This is actually an amendment to the illustrative examples that accompany IFRS 16. What I mean by that is the illustrative examples are not part of the standard. They are issued there as guidance to help with the application of the standard, but they are not the authoritative mandatory requirements of the standard. So officially, they are not part of the standard. And on that basis, this amendment technically has no effective date. It's not something that has a particular point at which it becomes effective, but rather is just there to help remove some of the confusion that's arisen as a result of this example. The example in question is example 13. And example 13 of IFRS 16 referred to an example of a reimbursement that the lessor paid to the lessee relating to a leasehold improvement. That example then goes on to explain that that lease incentive must be accounted for using the guidance for lease incentives in IFRS 16, but the example did not clearly explain why the reimbursement was considered a lease incentive. And the result is that many people who are applying the example to try and understand how IFRS 16 works were confused, because the assumption was, does that mean that all reimbursements relating to leasehold improvements are lease incentives and must therefore be accounted for as such? Or is it a case of the facts and circumstances, or how should these things be dealt with? So nothing's changed in respect of lease incentives. A lease incentive is excluded from the lease liability if it relates to a lease incentive to be received in future, and it is excluded from the right of use asset if it is a lease incentive that has already been received. But the example itself has been amended to remove the reference to the reimbursement, so that there's no longer this confusion as to whether a lease incentive is a reimbursement is a lease incentive or not. You still need to apply the guidance of IFRS 16 to anything that is a lease incentive, but the amendment just clarifies that particular example to avoid the confusion that existed there. And then the last amendment, before I look to any questions, I see some questions have been coming through in the Q&A, but let me just finish off the last topic, and then we can close off the session. This amendment relates to IAS 41 on agriculture. IAS 41 requires biological assets and agricultural produce to be measured at fair value. And fair value, as we know, is measured in accordance with IFRS 13, the standard on fair value measurement. IFRS 13 is the framework standard that explains how to determine the fair value of any asset or liability. A couple of years ago, the IASB amended IAS 41 to remove the requirement for entities to use a pre-tax discount rate when measuring discounted cash flows for the purposes of fair value measurement. However, this is just, you'll see this amendment is really just a housekeeping issue. When they made that amendment in 2008, paragraph 22 of IAS 41 still said that an entity does not include any cash flows for financing the assets, taxation, or reestablishing biological assets after harvest. So here you have a situation where for years, the standard spoke about using a pre-tax discount rate, but then there was a reference to taxation in the cash flows. And the question was now, somewhere along the line, somebody picked up on this discrepancy. And the question now was, does this now mean that we could have taxation in the cash flows, or should we exclude cash taxation, and so on and so forth? Given that IAS 41 refers us to IFRS 13 anyway in terms of measuring cash flows, there's no longer a need for that reference, so the amendment simply deletes the reference to taxation. So the long and the short of it is, when you're measuring fair value of a biological asset or agricultural produce, you use a pre-tax discount rate and whatever cash flows are appropriate in terms of IFRS 13. These amendments under the improvements project are all effective for years beginning on or after 1st of January 2022. Earlier application is permitted. The only exception is, of course, the amendment to the example in IFRS 16. As I say, it's just an amendment to an example, so that example has been affected already, so there's no effective date in respect of that. As you can see, folks, the amendments under the annual improvements projects are very, very specific, in some cases rather obscure, in some cases purely technical, but hopefully as a result of these improvements, the body of IFRS standards has been improved to help the application of IFRS standards going forward. I see there have been a couple of questions that have come through, so let me respond to those in the time available. A question, I assume it relates to IAS 16's amendment on the proceeds from prototype units. The question from Edmund Flores: if the samples produced when testing the equipment are unsold at year end, should we classify them as inventory? Yes, I would imagine so, because we are told by IAS 16 that we account for those costs incurred to produce those items as inventory items. So I would imagine that if they are unsold, that we would classify them and account for them as inventory items. Is the effect to the income tax after the retrospective amendment? I'm not sure I follow that question. Perhaps if you could, yeah, I'm not sure about I'm not sure if I'm understanding the question correctly. So if you could elaborate further on that question, please. Then the next question, based on the IFRS, do accounting standards require accruing the impairment of accrued account receivable and bad debts? What is the accrual ratio? Again, I'm not sure if I'm losing something in the translation, but you measure any bad debts or any impairment of accounts receivable using the principles of IFRS 9, which I guess we haven't really discussed. Impairment of financial assets, that can certainly be a topic for a future webinar, given that there's been a couple of questions around ECLs. But yeah, so you would need to apply the principles of IFRS 9 to deal with any impairments of accounts receivable, which would then give rise to a bad debt. Then I see a question: what is the difference between IAS 39 and IFRS 9? Can I kindly clarify? So, well, the one is the newer standard of the other. So IAS 39 came to an end in 2018 when it was replaced by IFRS 9. It still exists in a very limited fashion because the new standard permits the continued application of IAS 39 only for certain hedge accounting relationships. But if you're not applying hedge accounting and you don't have any of those qualifying hedge relationships, then IFRS 9 now governs the accounting for financial instruments. So with effect from 1st of January 2018, IFRS 9 replaces IAS 39, and it comes with new principles around classification and measurement of financial assets, new principles around impairment of financial assets, some of these questions around accruing for bad debts, and new requirements for hedge accounting as well. Last question that has popped up here: in my opinion, which amendment of standards do I think would affect banks and financial institutions the most? Any of the amendments which are relevant. I mean, for example, over the course of today, banks and financial institutions may have leases and they may be affected by COVID-19, by the amendments that I mentioned under COVID-19. The classification of financial liabilities as current versus non-current, I'm just referring to the ones we discussed today. Those would also impact banks to the extent that they have borrowings and may be affected by that in respect of their financial liabilities. Of course, the 10% test that we covered very briefly in the annual improvements project could be relevant. So I think it's one of those things where you would need to consider what your balance sheet contains and which of these amendments affect you. Going outside of these topics, I mean, out of the recent amendments, we have also seen disclosures, or rather some banks and financial institutions are involved in the insurance space. So IFRS 17 would also impact that. I see a comment has come in here in the chat: loan restructuring as well. Yes, certainly in relation to the discussion around current liabilities. So I guess that then takes us to the end of our session. We're about 4 minutes over the deadline, so apologies for keeping you, but I just wanted to respond to those questions. What we've covered over the course of the last 3 hours, we've spent a bit of time looking at the work of the International Accounting Standards Board in progress. By explaining the process, I think that's helpful in you understanding how these amendments come about, and also some of the things that we can anticipate over the coming months and over the near term. And then we've spent some time talking about the recent amendments to IFRS standards over the past 20 odd months or so, by talking about the amendments to IAS 1, the amendments to IAS 16, IAS 37, IFRS 16, and the annual improvements to IFRS standards. That's it for today. Thank you to all of you for tuning into this webinar and for being part of it, for your participation in the polls, for the questions that you have asked. To the extent that any of you have any additional topics that you would like covered, please share that feedback with CAMED so that they can decide on who the most appropriate person will be to present those topics, and they can bring topics of relevance to you. From my side, it's been a pleasure and a privilege to have been part of the session, and thank you to CAMED for inviting me to share our IFRS knowledge with you. To the extent that any of you have any questions or need some assistance in the application of the standards, please feel free to reach out to us. Thank you very much. Have a wonderful Sunday evening, and I look forward to being part of a webinar in the near future. Thank you very, very much.
Les, thank you very much as well for being here with us and taking your time, your energy, and your expertise to help us here in Cambodia to develop ability in financial reporting. And I wish you to have a lovely Sunday afternoon.
Thank you very much, Lacey. Have a good day. Thank you. Bye-bye.